Yeah. Hello, good morning, good afternoon, and good evening. I am Yagnesh Desai, today's host, and I'm conducting the event, which is organized by the Accounting Standard Board of ICI and IASB for the better communication on the financial reporting. Today's webinar is to enrich and to reach out all the all the accounting fraternity about the changes which are going to be there in IS1. These are all. This standard was introduced back in 1975. After 45 years, almost 4.5 decades, this standard is going to be changed topsy-turvy. What are the changes? We are going to see what are these changes are. To brief you in a nutshell, I will tell you what are these changes about. These changes are about the totals, subtotals, the presentation of the financial statement, and more so the statement of profit and loss account. We all know, sir, also that today's biggest challenge for the any accounting fraternity or the profession is to be relevant, to be updated, and to be upgraded. Accounting standards are most evolving standards and they keep on changing. It has been the endeavor of the IASB and ASB of ICI to make the changes as equal to the changes made by the IASB. Today, we have all the panelists and speakers who are the who's who of this field, who are the well-talented person and especially the staff members and the vice chair from ICB. Today we have our president, vice president, chairman, accounting standard board. They are all going to share their wisdom and going to apprise you as to what are the changes which is going to take place. Friends, I'm going to tell you one more thing. All these panelists and the guest speakers have just come not to share their views with you, but also to know your views about the changes which are going to take place. And for the first time in India, you'll be surprised to know that ASB is introducing the polling. Yes, sir. And not just one, but there'll be two pollings to know your views, your suggestions, and all these. So look at how important our audience is today. That before formalizing and during the process of formulating the new standards, they want to seek your views and your suggestions also. And now I welcome Chairman Accounting Standard Board, none other than Mr. MP Vijay Kumar ji. And you must know something about him. He's not just a chartered accountant, he's a cost accountant and he's also the company secretary. So well qualified person, and he is one of the most respected person in the students at the Chartered Accountants fraternity. So I welcome Accounting Standard Board Chairman CA MP Vijay Kumar ji for his welcome address. Over to you, sir, MP Vijay Kumar ji.
Thanks, Yagnesh. Greetings to all. Trust all are safe and healthy. I have great pleasure in welcoming you all to this joint outreach of ICI and IASB on the exposure draft on general presentation and disclosures aimed at better communication in financial reporting. Sincere thanks to Sri Atul Kumar Gupta ji, President, Sri Nihar Jambusarya ji, Vice President, Ms. Sue Lloyd, Vice Chair of IASB and Chair of IFRIC, Ms. Nilisha, ED of Executive Director of IASB for the time and consent to share their thoughts in the context setting session, which is to be followed by 3 technical sessions. I welcome all the panelists, Past President Sri Amarjit Chopra ji, Past President Sri Nilesh Vikamsi ji, C.H. Zavri ji, Chair of AOSSG and my mentor at the ASB as Chairman for the years 2016-19, and all other panelists who are industry leaders and senior practicing accountants. This exposure draft, when finalized, seeks to replace IAS 1, which was issued in 1975 as Disclosure of Accounting Policies, which eventually took an evolved form of presentation of financial statements in 1997 and was revised in 2007. Since 1997, this standard would have effectively served 25 years by the time This exposure draft gets finalized as a standard and hits the road. And this is the period of the new millennium where there has been a huge amount of changes in world trade, nature of business, capital flows across jurisdictions, etc. It is important that financial reporting should also change and stay relevant. Else, there is a risk that financial reporting will be treated as a template for statutory compliance, and the primary users of financial statements, the investors and the lending community, will find their own path of engaging with enterprises for their decision-making needs. The proposal of management performance measures in the standard is a step in this direction to stay relevant, apart from having an income statement presentation which reflects the way the managements and investors today look at operating performance. The proposed standard is about 120 paragraphs, followed by Appendix A for definitions, Appendix B, application guidance of about 85 paragraphs, with consequential amendments in IAS 7, 8, 34 and IFRS 12. As Yagnesh mentioned, changes are largely in the context of the statement of financial performance, commonly referred to as P&L, the statement of financial position, what we commonly refer as balance sheet, and the statement of cash flow have limited changes. On the face of it, the income statement will look like it's almost a mirror of cash flow, but it's not really so. The exposure draft includes the proposals of the IASB to improve how information is communicated in financial statements, with a focus on information about performance in the statement of profit or loss. The proposals were developed by the board as a part of its primary financial statements project, which is part of a wholesome work of the board on better communication in financial reporting. This project is a response to the strong demand from stakeholders and in particular the users of financial statements to undertake a project on performance reporting. I am confident that the views of President, Vice President, Vice Chair of IASB, ED, Executive Director of IASB, and the presenters and panelists of the 3 technical sessions will be extremely useful to get a better insight of what this draft standard seeks to achieve. We seek each of the participants' views on the exposure draft, preferably by applying these paragraphs to the situations of your company or clients, and advise us on areas which require more clarity or an edit. We request you to send us by your comments by the 18th of September, that's next Friday, as we have an Accounting Standards Board meeting on the 21st of September to deliberate and submit our comments to the International Accounting Standards Board. We have thus far done 2 outreach programs, and today's outreach is the 3rd one, and we are happy to do it jointly with IASB and thankful to IASB leadership for their consent to do it jointly. We have also constituted 2 study groups where we have done a line-by-line reading of the standard, and I'm extremely thankful to the 4 Indian companies who have participated in the field testing of this exposure draft, and I'm sure the outcome of this field testing will be very useful to IASB in finalizing the standard, since all the 4 companies are pretty large companies and coming from different industries. I am thankful to the highly energetic Vice Chairman of the ASB, C.S. Sanjeev Singhal, who will be moderating the 3 technical sessions, and the Secretary of the ASB, led by C.A. Vidyadhar Kulkarni, who have worked for over 3 weeks in coordinating all aspects of the event. Thankful to IASB and IDA in particular for the guidance for conceptualizing the event. Thank you all once again for joining us in this IASB ICA joint outreach. Over to you, Agnish.
Chairman, sir, you set the tone of the today's program. You set the tone of the today's webinar. And friends and all viewers, take my words, there'll be a huge takeaway from this. There'll be a lot of enrichment in your knowledge. And now I invite Vice President CA Nihar Niranjan Jambusurya, who have served the profession for at least 37 years. 25 years or 26 years in the practice and thereafter in the service in the industries. So, Chairman Vice VP sir, please welcome and address the session.
Thank you, Agnes. Good morning, good afternoon, good evening. This is going to become a new normal because now on virtual mode, from every part of the world, we have got attendees and participants. Honorable President of the Institute, CA Atulji, the Chairman and Vice Chairman of Accounting Standard Board, CA MP Vijay Kumar ji and CA Dr. Sanjeev Singhal, the two respected past presidents of the Institute, Amarjit Chopra ji and Nilesh Vikamsi ji, Vice Chair IASB, Shiv Lloyd, Executive Directors, officials of IASB, and Council colleagues and members who are attending this global outreach program. At the outset, let me compliment ASB for organizing this global outreach program on the proposed new IFRS, on the exposure draft on primary financial statements, and you have given a well-deserved title, Better Communication in Financial Reporting. If I may supplement what Chairman ASB just mentioned, that IAS 1 is getting revised after almost 55 years. And what we see this time is, although it was revised in the past, this time it leads to a major reform. In the presentation of profit and loss, many new phrases are being introduced. As a part of IFRS, we never had the concept of unusual income, unusual expenditure. We never had a concept of integral associates and JVs. And what is most relevant and important is management performance measures, which is a non-financial information. And for the first time, it is becoming a part of any accounting standard. So far, we never had this. And it is at right and appropriate time that this is being introduced. Many governments are now insisting on business responsibility reporting. So this non-financial reporting will go a long way in supporting these initiatives of various governments too. The exposure draft also proposes to reduce presentation alternatives. The panel is very rich and will discuss every aspect of the exposure draft. But I'm just putting one idea, whether it would be right to withdraw all alternative presentation alternatives, or should we leave some flexibility to the organization? Because depending on situation, sometimes some presentation alternatives may help presenting it better. I leave it to the panel. It is a rich panel which will discuss it well. At the ICAI, I may only say that corresponding to IFRS, the Accounting Standard Board was very quick in formulating the corresponding index with a very few carve-outs, which were only much required. But otherwise, it is absolutely in line with IFRS. We have done well to provide education material to our members, provide what is called ITFG, which is parallel to IFRIC. That is, whenever there are queries, we give reply to them as to what should be the correct treatment. We have held number of certificate courses to educate the members well. And this time, during outreach, the members will get the flavor of what is coming in. And after it is finalized, we will do well to see that our members and the reporting community is well educated about the new standard. I understand 30th September is the deadline to give inputs. And as Chairman mentioned, IASB is holding one more meeting to have all these inputs consolidated to be sent to IASB. Let me once again congratulate the ASB for arranging this global outreach program, and it will be a good value add, and every participant will have a good takeaway at the end of this program. Thank you so much for inviting. Back to you, Yagnesh.
Okay, VP sir has given the tip of an iceberg as to what to expect. Unusual income, unusual expenses, management performance, and everything. So now we will see in some time from now. But before that, we must hear our President CA Atul Kumar Gupta ji. A lot can be said about him, but for paucity of time, I'll tell you something in brief. He is a man with an astute intellect and quick understanding of the subject. He has been instrumental in formalizing the GST, and his dedication. He's known for his dedication for the profession, and since last 2 decades, he has been serving the profession CA fraternity. And as far as Central Council is concerned, he joined in 2013. And now I welcome the President CA Atul Kumar Gupta ji.
Thank you, Yagnesh ji.
And over to you, sir. Over to you, sir.
Thank you, Yagnesh ji. And at the outset, the Honorable two very eminent personalities of our profession, past President CA Amarjit Chopra ji and Nilesh Vikamse ji in absentia. Madam Soy Lloyd, the Vice Chairperson of the IASB. All my colleagues in the council, Honorable Vice President MP Vijay Kumar ji, Sanjeev Singhal ji, former Central Council member and AOSSG Chair Javre sir, and all the colleagues from the council, Sunil ji and other from all the global personalities. At the outset, I welcome all of you in this global webinar and welcome you on behalf of the Institute of Chartered Accountants of India. And I acknowledge and appreciate the effort put in by the Accounting Standard Board to hold this outreach meeting, looking into the exposure draft and the submissions of the comments of the ICAI by the due date, that is 30th of September 2020. Friends, I also noted down that the new standard will create the new benchmark, whether it may be related to the profit and loss account or the various treatment of the various disclosure of the various activity, whether it may be the operating profit, investing, or some financial. Friends, you all will agree with me. I used to say that the chartered accountants or the professionals are the financial army of the country, because they, when they benchmark the international standard, not only they pave the, they protect the interest of the common man, but also they are the catalyst for the growth trajectory of the companies when they are globally moving into this today's environment. And it is a high time when we have to have a more and more research into all these aspects related to the presentation of the financial statement, so that the readers and the user of the financial statement, the various stakeholders, can rightly acknowledge and appreciate the position of the financial statement through or presented through these all standards. I appreciate the contribution made by the ASB that they are working 24/7 in support of the IASB. And even when the last occasion, the chair of the jury from the IFRS Foundation, sir, was here in Mumbai for one of the meeting along with the SEBI and other regulators. So we shared him that our team is working, and even on that occasion also we shared that, and I'm happy to intimate the IASB, Madam Soy Lloyd and all the colleagues here, that as per the commitment given to the chair, that we establish the Sustainability Reporting Standard Board, and the founder chairman is with us, Dr. Sanjeev Singhal ji, who is also the vice chairman of this Accounting Standard Board. And I'm happy to intimate you that we are working very closely on this Sustainable Development Goals 2030 and how the matrices and all these things can be developed while in support of the Accounting Standard Board. Here even I will request the Madam Soy Lloyd and the IFRS trustee, the entire board of the IASB, that in case they can also provide us the necessary support in terms of nominations from the IASB or the IFRS Foundation on the Sustainability Reporting Standard Board. So that will also ease out, provide that kind of a necessary guidance can be provided for the activities of the Sustainability Reporting Standard Board. Apart from that, before I sign off, because as per the schedule, Madam has to speak at 4:20, so I will sign off immediately. But only point what I wish to share with you that looking into the various initiatives at the global community on the research in the field of profession, ICI has recently launched an international research award as well. The details are available on the website of the ICI. It is an initiative to recognize the efforts put in by the various global professionals in the area of the transparent reporting or the taxation and other aspects related to the profession. So I will urge the chair and Madam Vice Chair of the IASB and all the colleagues also that in case you can disseminate this information to the various jurisdictions and the POs and the other colleagues who are associated with the IASB, so that it will be kind of an initiative which will recognize the efforts put in by the professionals in the financial landscape. With this, I convey my sincere thanks. I just wish to convey to Madam Lloyd that during this COVID pandemic, the ICI and the ASB put in all the efforts. We released the 3 very important advisories at that point of time. One was the impact of coronavirus on financial reporting and auditors' consideration. The another one is about the expected credit loss approach for impairment loss of the financial asset. And the third one is about the FAQs related to the critical accounting areas such as the impairment of asset, fair value measurement, and so. And apart from that, there are the number of webinars, global webinars being organized for the members at large. They launched the refresher course in this particular point of time, which is available online. So online refresher course were also being organized. So there are a number of initiatives taken, and I believe that under the guidance of the IASB, the ICI will be looking forward for more close association while working with the IASB and ultimately with the object, as I mentioned, that to protect the interest of the common man vis-a-vis to be the part of this growth trajectory at the global level. With this, I once again welcome all the respected colleagues here from the global arena, and over to Yagneshji to request Madam to address all of us.
Thank you very much, President Sir. And as President Sir has said rightly, lockdown has unlocked the potential of ICAI. ICI has arranged a battery of webinars and everything for the benefits of the members, not just the members, for even general public as well. So today's program is going to be divided into 3 parts: panel discussion 1 related to the subtotal and categories, panel discussion number 2, expenses and unusual income and expenses, and the third is management performance measures. All 3 sessions are going to be moderated by none other than Dr. Sanjeev Singhal, who is the Vice Chairman of Accounting Standard Board. And now I invite very gracefully Madam Sue Lloyd, the Vice Chair of IASB. We are very privileged to have you, Madam, with us, and we would like to hear from you in your opening remarks about the approach of the IASB about this out. And along with her is Ms. Nilisha also, and she's also joining for opening remarks on the IASB. So it's over to you, ma'am. So,
thank you very much, and the privilege is mine to be invited and to have the opportunity to do the outreach with you today. I'm waiting for Aida to put my slides up, but while I'm waiting for that, just to say, firstly, it's very nice to see a lot of familiar faces today on the screen, and to have the opportunity. I'm very much looking forward to hearing what India's stakeholders have to say about our important and I think exciting proposals in the primary financial statements project. One good thing about the new normal is I think we have the opportunity for a lot of people to participate, because remote participation actually can sometimes increase the number of people that are involved. But from my side, I have to say that after my trip to India last year, which was a very fruitful trip, both from a technical perspective, but also enjoying your hospitality. I'm looking forward to when we can return to the old normal and we can meet again in person, and I can come and see my friends in India in your home country. But until then, thank you very much to the Institute for organising this very important event today, and I look forward to hearing what you have to say. I was just going to comment a little bit, first of all, on the work that we've been doing from our side, where we've also unlocked our potential to deal with COVID-related issues, and to talk about that for a few moments before I hand over to Neely Shah, who will actually introduce the main points and the perspective of the board on the primary financial statements proposals that we discussed today. The first thing I just wanted to comment on very briefly is the work that we've been doing to try and to support our stakeholders globally in the context of this difficult pandemic situation that we are all dealing with. And we took the opportunity to provide some materials to support our stakeholders applying the standards. We issued some materials about the application of our expected credit loss model. We are also aware that our stakeholders have got a lot of other things to focus on at the moment beyond talking to us about new ideas we have for accounting standards. With that in mind, we have worked to give you some more time. So, for example, the document that we're actually talking about today, the primary financial statements project, we extended the comment period until the end of September to make sure that we actually allow sufficient time for you to give us your thoughtful, considered feedback, which is so important to developing good quality documents. We're lucky at the IASB that our technology has meant that we are able to continue working very effectively, even though we've all been working remotely since the end of March. That meant we've been able to publish our amendments to IBOR on our normal time frame. They were issued just a few weeks ago, and we also published our final changes to our new insurance standard in June on schedule for the deferred effective date of 2023. We have made some changes, though. In addition to extending consultation periods, we've deferred the effective date of some changes that we recently made to IAS 1 for classifying liabilities as current and non-current to allow stakeholders more time to focus on those changes. Aida, if I could look at the next slide on our consultation documents. So today we're going to be focusing on our primary financial statements document. Our comment period is open until the end of September. As noted earlier, the Institute is looking for your comments by the 18th of September so they can amalgamate them, which is a good reminder. We've also got another couple of documents that are out at the moment for comment, which are also really important. One is on goodwill and impairment. The question of how you should account for goodwill subsequently, whether it should be impairment only or amortized, but also an important set of proposals to improve disclosures around the performance of acquisitions post-acquisition. For people involved in acquisition accounting, if you could look at that document, we'd really like your comments on that, and that's open until the end of the year. We've also got a review going on at the moment for accounting for small and medium-sized enterprises, and questioning our stakeholders about the extent to which we should change those standards to update them for changes in full IFRS. You'll see on this slide we've got a number of other consultations coming up later in the year, business combinations under common control and accounting for utilities, rate-regulated activities, and also importantly, we will be looking at how well the new consolidation and joint arrangement standards have worked in the post-implementation reviews of IFRS 10, 11 and 12 later this year. And then peeping ahead to next year, we're going to be asking you for your thoughts on management commentary, the changes we should make to our practice statement to update it for changes in sustainability reporting, and last but not least, we'll be coming to you early next year to ask you for your views on what our priorities should be for the next 5 years in our standard setting, when we're going to step back and talk about what the balance of our project should be and what really matters for our stakeholders going forward. I'm going to stop there and hand over to Neely. I'm going to be in listening mode today, and I'm really looking forward to hearing your thoughts on our exciting set of primary financial statements projects. And thank you very much for organising this event.
Thank you, Suji. Thank you, Suji. Now invite Ms. Neeli Shah to give her address.
Thank you, Yagnesh, and thank you, Sue. Well, good morning, good afternoon, and good evening to all of you. I just wanted to echo Sue's thank you for giving us the opportunity to speak with you today. For me personally, it's very special to be speaking to a conference in India, and my only regret is, even though it's great that we can do this virtually, I just regret that we couldn't meet face to face. So hopefully sometime when all of these COVID-19 problems go away, we can have a chance to do that in the future. So let's talk about why we are all here. The previous presenters gave you a little bit of a flavor for the board's project on primary financial statements, and we have detailed discussions in the panels coming up. But just at a very high level, what is the purpose of the board's project? And simply, it's to improve communication in the financial statements with the focus on the profit and loss statement. So if we move to slide number 6, you might be wondering, well, why is the board even working on this project? And the reason is because there are a number of problems that the board has become aware of. And as you can see on the slide, these problems really come down to two main areas: the lack of comparability and the lack of transparency for investors. So the board has proposed a number of potential requirements to address these concerns, but also, as Nihar had pointed out, there's a little bit of flexibility in the board's requirements to ensure that companies have their ability to tell their own story. So let me give you just a little bit of a flavor before we move things on to the panels. Aida, if you could go to the next slide. So there are three main proposals in the board's exposure draft. As you can see with the first row of the slide, the concern about lack of comparability applies to subtotals. The problem that we see today is that different companies use different subtotals, or you might see some companies use the same name, use the same subtotal, but they might mean different things with those subtotals. And this happens not only across countries, but we also see it within companies. So for this, the board is requiring or proposing to require new subtotals. And it's also defining those subtotals to ensure that comparability. On the second line of this slide, you will see that we'll have a panel on the proposals related to disaggregating information. This is also a really important area for investors because they need the transparency to perform their financial analysis. Now, there are a number of disclosure or a number of presentation requirements within this section of disaggregating information, which I will leave to the panel, but you've already heard a few of them today. Requirements around unusual items, improvements to disaggregating the information in operating expenses by function and by nature, as well as several others, which the panel will discuss. And then the final row on this slide relates to something that we call in the exposure draft management performance measures. Now, this is a new term in the exposure draft, and for right now, it's best to just think of it as being similar to non-GAAP measures or alternative performance measures. There is a difference, and I'll explain that in a little bit, but the concern here is that while these management performance measures provide useful information for investors, at the same time, some of the disclosures is not very good. And so in order to, again, provide that transparency, the board is looking to has proposed requirements to improve the disclosures around these management performance measures. So Aida, if we can go to the next slide. This slide presents the project status, and you've already heard some of the previous speakers highlight the key date. The comment period for the exposure draft will be ending on the 30th of September, but Vijay had requested comments by the 18th of September, which would be very helpful for us to hear as much as we can from all of you. What happens after that? The board will consider all of the feedback from this outreach, from the comment letters, from the field work that is being performed, as well as other evidence that it has obtained throughout this period. It will consider that information, redeliberate the proposals, and then if these proposals are finalized, they will be issued in a new IFRS standard on general presentation and disclosures, which, as the previous speakers had mentioned, will replace IAS 1. So hopefully you will find this conference will answer most of the questions that you have today. If you are interested in learning more, we hope you will visit our website. And at the bottom of this slide, you can see some of the additional pieces of information that are available on our website. So with that, Yagneshji, shall I turn things over to you?
Yes, thank you so much. Thank you, Nili. And you really have dwelt in great detail about the nitty-gritty in a very succinct manner, very comprehensive manner. And I'll give some small example here. Like, for example, as you had said correctly, IS1 requires the presentation of the share of profit and loss of associates and joint ventures accounted for using the equity method in a separate financial statements and as a separate line, but it does not specify the location. Some entities show is above the operating profit, some entities show is after the operating profits. So now the endeavor of IASB is to streamline these subtotals, totals, and the presentation of certain key items. And for this, all the three panels are going to be moderated by none other than Dr. Sanjeev Singhal, Vice Chairman, IASB Accounting Standard Board of ICI. He has been Vice President with the Cyber Media, Executive Vice President with the Finance with Religare, and he had been Vice President with the Jubilant Group also. He has been serving the profession for the last 20 years. And the best part of it is that he's also the government nominee at the NACAS and contributed towards resolving the industry and many professional interest issues. And he's also contributed as a member of CII, National Financing Report Committee, and the chairman of CII. So, Sanjeev ji, it's a great pleasure to introduce you, and we'll have a very enriching session. Friends and guys, you see, now the excitement is going to start now. And don't forget to give your views, suggestions on the three polls, which ASB is doing for the first time. And they want to hear your views and suggestions. They want to hear the voice of Hindustanis. So I invite Dr. Sanjeev Singhal to take over, sir, for the panel discussion number 1.
Thank you very much, Yagnesh bhai. Before I start off, can I ask the administrator to kindly remove the presentation from the screen so that the panelists are visible? Thank you very much. So very good evening, good morning, good afternoon to you all. As is the case on the virtual mode, we say Jamja ji, good morning, good evening, good afternoon. My thanks to the Honorable President ICI for giving his presidential address, the Honorable Vice President Nihar Jambusaria ji for his insights, and one of the option he talked about, that whether there should be a complete curtailment of options. The Vice Chairperson of the International Accounting Standard Board, Sue Lloyd, my Chairman at the Accounting Standard Board, CA MP Vijay Kumar ji, our government nominee at the Central Council, Sunil Kanoria ji, two of our esteemed past presidents, CA Amarjit Chopra ji and CA Nilesh Vikamse ji, and all the staff members from International Accounting Standard Board, my council colleagues, and the very esteemed participants. This is indeed a pleasure to be a moderator of the 3 sessions of this exposure draft on the proposals by the International Accounting Standard Board. The first panel is on the subtotals and the categories. So before I invite Nick Barlow, the technical staff, IASB, for the introduction on the topic, let me introduce 3 illustrious panelists today, whom we have for the first panel. The panel is led by none other than our Honorable Past President, CA Amarjit Chopra ji. CA Amarjit Chopra ji has been the Vice President and then the President of the ICI. He has been the Chairman of NACAS, National Advisory Committee on Accounting Standard, and now is a member of the National Financial Reporting Authority, NFRA. He has also been on the IRDA, SAFA, CAPA, was a member of PAODC committee of IFAC for 3 years, and is also served as its vice chair. He has been the audit committee chairman of the many prestigious companies in India. He was also nominated by the government as a member of Investor Education and Protection Fund Authority, and currently the Ministry of Corporate Affairs has also appointed him as a panel member, a panel which is constituted to look into the audit independence related issues. He is joined by two very esteemed colleagues from the industry. we have CA Jayesh, who's the Executive Vice President and Deputy CFO, Infosys Limited, and we also have CA Ramnan GV, who's a Group Financial Controller of Tata Motors. As far as CA Jayesh is concerned, he has over 20 years of professional experience, including business reviews and business planning, auditing, SOX compliance, India and international tax funds management, reporting under India GAAP, US, IFRS, ERP implementation, and post-merger integration of companies. And he's currently the Executive Vice President and Deputy CFO of Infosys Limited. As far as CA Ramnan is concerned, he's the Group Financial Controller of Tata Motors Limited. He was the Senior Controller, GE South Asia Operations, and the CFO of GE John F. Welch Technology Center in Bangalore. He, besides being a chartered accountant, is also a cost accountant and is a commerce graduate from Madras University. And before joining Tata, he has worked in various other companies. We welcome you all the three panelists, Amarjit Chopra ji, Jayesh ji, and Ramnan ji. A very warm welcome to this first panel. I would like to start off with the first question, and basically we will have it. Before I ask the first question, I would like to invite Nick for giving a brief introduction of the topic, and after that we'll start the panel discussion. Over to you, Nick.
Great, thank you very much, and looking forward to the insights of the panel. So to introduce the subtotals in the statement of profit or loss and the board's proposals in that area, if we could move to the next slide. And I think in the introduction, overall, we got a good flavor of the demand that there was, or that the board heard, for more comparable subtotals, and to give a bit more of a flavor of the diversity that's developed in practice over time with the existing requirements in IS1. The technical staff took a sample of 100 entities, and we noted that while there was some similarity in the fact that 63 of those entities all presented operating profit as one of their key subtotals, we found that there was quite a diversity within that sample. So of the 63, we had at least 9 different definitions of how that operating profit was calculated. And we say at least 9 because we were able to identify 9, but in some cases, there were cases where it was unclear how that was calculated. So if we can move to the next slide, the best way to discuss how the board has addressed this in the proposals is probably by way of an example. And so a couple of caveats with this example up front. First, to just note, this doesn't represent all potential line items that are here. This is just an example. A particular entity may have others, depending on what the operations are, and may have different required line items that it needs to present. Additionally, we'll notice that this is presenting operating profit, including an analysis of expenses using the nature of expense method, so we can see changes in inventories, raw materials, employee benefits, or in other words, inputs. For example, an acceptable presentation could alternatively be by function, or we would have a cost of sales, administration, for example, potentially research and development. But this example is simply not showing that scenario. And then lastly, just to note, the board is not proposing any changes to how tax and discontinued operations are presented, and so that would be continued as we see them today, and not shown completely in this example. So, what is the board proposing? If we look at the center, we can see 3 main subtotals, and then down the right-hand side, we can see the 4 categories in which income and expenses would be required to be classified. And if we start off with the first subtotal, operating profit, as I mentioned in the last slide, this was a widely used measure. And so the board has proposed to define this in a consistent manner. And to do that, it's designed the proposals for operating profit to capture the main business activities of the entity, but also those activities that support the business. And so in that manner, it's a default category. And so to achieve that, the operating profit and the operating category would include those income and expenses that do not meet the definitions of the other categories, which we see the integral, associates and joint ventures, investing, and financing. And the board's defined it in this way because it is more adaptable, diverse business models. It avoids the potential difficult judgments that leads diversity with a direct definition of the operating, and therefore is seen to result in a more comparable subtotal, which, as we saw earlier, was the goal of introducing these subtotals. So if we move on then to the profit before financing and income tax subtotal down at the bottom, the aim of this subtotal is to allow for a comparison between entities independent of the financing decisions that it makes. And to do that, we've introduced the financing category, which would fall below that subtotal and would include expenses from financing activities, which the board has defined, but we can think of as including things that we would consider as borrowing costs today. It also would include interest on other liabilities. We can see it in the example here, unwinding of a discount, for example, on pension liabilities or provisions. And not shown on the slide, we would also include in this category interest on cash and cash equivalents. And the reason for that is that many users see excess cash as net of the financing activities, and the board thought cash and cash equivalents was a good proxy for that, and so is included in the financing category. Now, above that, profit before financing income tax is our investing category. And this category aims to capture those investments that generate, or those assets that generate returns individually and largely independently of the main activities of the entity. And so we can see that will capture things like dividend income and as we can see, share of the profit or loss on non-integral associates and joint ventures. And now some of you may be wondering what exactly is non-integral associate joint ventures. And this arose out of the question about what to do with the current line item for the share profit or loss from associate joint ventures accounted for at the equity method, and which was the best category to include this information in. Now, the feedback from users and investors was that equity method accounting, combining the tax, also the financing and being a net number, should stay outside of the operating profit because it makes it difficult to make margin analysis with this net number and to compare that to other entities. On the other side, there are many entities that told the board these types of entities, these types of associates and joint ventures can be very close to operations and they consider it part of their operating profit. And so the compromise that the board reached was to define an integral associates and joint ventures, which would identify those equity accounted investments that are closer to operating and would be then categorized in its own category with a subtotal drawn below so that users would be able to see the operating profit in combination with those share of associates and joint ventures which are close to the operating. Those associates and joint ventures that are not integral would then be included in the investing, as they're those that are meeting that definition of investing, generating returns independently of the operations of the entity. So those are the main subtotals and the categories that are being proposed. Now, many might wonder what happens for an entity such as a bank, where that financing category is really the main business of the entity. And so to deal with this, the board has proposed some principles to move those expenses into the operating category when that makes sense. And that principle is around when an entity provides financing to customers as its main business activity. And when an entity provides financing to customers as a main business activity, it has an accounting policy choice to move all of those expenses that we see in the expenses from financing activities into the operating section, or it can move those expenses relating solely to that provision of financing to customers into the operating section. And this would allow the entity to show the subtotal of that interest revenue that's coming in into that operating section, less the expenses from the financing, and show the subtotal of those, which we'll see in just a second. Similarly, the investing for those entities that have investing as a main business activity, when they invest in the course of their main business activities, that income on those assets that are generating returns independently could be moved into the operating profit section. And so this slide here demonstrates an example of an investment in retail bank, which does both of these activities. And as we can see in the green, the interest expense has moved out of the financing category, so we can have a net interest income subtotal. We can see also, though, that left behind is at the bottom, the share of profit or loss from non-integral associates and joint ventures that would not move into the operating category. And those items highlighted in gray are the income and expenses that would otherwise have been in the investing category, but because this is invested in the course of this entity's main business activity, are moved up into the operating profit so that all of its main business activities are incorporated in that operating profit subtotal. Again, just to highlight, in this case where the financing activities have been moved up into the operating profit, there would no longer be a subtotal for profit before financing and income tax, because it would no longer make sense to have that subtotal when the financing is above that line. So those are the proposals for the subtotals, the categories, and how they've been adapted to deal with the investing and financing type entities. I'd like to turn it back now to hear the panel's views.
So thank you very much, Nick. And I would request, the presentation is off. So now I would like to have the views of the panelists. And I would like to start with our Honorable Past President, CA Amarjit Chopra ji. Sir, a very good morning and welcome to the panel, sir. Sir, I would like to ask you, this IASB proposal to present the income and expenses by classifying those into operating, investing, associate, joint venture, and the financing categories. What do you think is the rationale for this approach? And any opening comment you would like to make, sir? Over to you, sir. Sir, you are on mute, sir. Please unmute.
My greetings to everyone, and particularly Sue Lloyd, Nick, Nili, and of course others. And if the Honorable President and Vice President of the Institute and yourself, and of course the Chairman of IASB, Mr. MP Vijay Kumar, and all the participants. What I can say is that, you see, all these proposals appear to be very, very simple, if you really ask me, on the face of it. But I think at times the looks can be deceptive. There's no doubt about it. And underneath these various measures which are there, I think many things have been said. But I must appreciate one thing about the entire move to do this. It will definitely lead to better communication. There's absolutely no doubt in my mind so far as this issue is concerned. Because earlier we were not prescribing any formats. We were just giving some of the items. Even like in India, I think under the Companies Act also we have given something minimum which needs to be taken care of rather than giving the format of the profit and loss account. And that way we were giving a lot of discretion to the various people, lot of discretion to the preparers of the financial statements. And there could be difficulties with regard to reading of those financial statements, particularly in terms of the comparability. But now with this format coming in, the kind of format which is being given, and particularly talking of the operating profit, talking of the investing activities, talking of the financing activities, and more importantly, to my mind, when you talk of the integral and non-integral operations, and non-integral operations being treated as an investing activity, more or less, I think it's a very, very welcome move. There is absolutely no doubt in my mind so far as that particular issue is concerned. The only thing that I was trying to find out from Nick's presentation basically is that in the operating side, there was one item of other income. I will only like to get into that particular part. Now, this other income, if it exceeds your main business income, how do you look at it? I will give you one example, Sanjay. Basically, I have seen many of the balance sheets, many of the profit and loss accounts, financial statements in India, where suppose you have taken the money from the shareholders for the purpose of the steel manufacturing. Steel manufacturing is not to be seen anywhere, or if at all is to be seen, it's in a major loss. But your main profitability is coming from a commission income. whether this commission income can be considered to be an operating profit. I think that's my point. That's my worry still, which will remain after this particular format. Can we really distinguish? Because one is main revenue generating activity. Even when I come to the cash flow statements, I will talk about that. One is my cash, you can say the main revenue generating activity, and one can be my principal business. I think these are two different things. When I talk of main revenue generating activity, that could be different from my main business. Now, how do I really try to look at that particular situation when it comes to the operating profit in that particular part? The other thing is that they have tried to bring in the concept of the unusual items. One will like to discuss it a little later. We have already the concept of the exceptional items. We have the concept of the extraordinary items. I think the way the unusual items have been defined here, that can cause more problems, that can cause more subjectivity than probably the solutions that it may provide for. I will like to stop here so far as this particular part is concerned, but I will definitely like to say one thing, that the entire concept seems to be very good, but it may still have little bit of a problem here and there. One of the problems I've already conveyed to you, and the unusual items basically itself might lead to a lot of subjectivity in the times to come.
Sure, sir. Thank you very much. And I saw that Nick noting down your point. I'm sure that when we come back to him, he'll explain that. Jayesh, first of all, my thanks to you for taking out time. We really value your presence. I'd like to ask you, in the exposure draft, the IASB has proposed again these three mandatory subtotals in the P&L, one of which is a subtotal for operating profit or loss. What's your view on the overall proposal, including this operating profit or loss, particularly from the perspective that you are preparing the financial statements? So, would you like to comment on this?
Yeah, thanks, Sanjeev, and thanks for having me here. Good afternoon, good morning, good evening, everybody, depending on which part of the world you're joining. And I hope all of you are doing well. Coming to your question, Sanjeev, I think first of all, this is a great initiative because we are doing something keeping the investor interest in mind. Ensuring that the financial statements are comparable. Today, what you look at in the market, even when we are comparing financials with our peers or with our companies in the same sector, we being financial savvy people, we do struggle comparing them because they are not comparable in true sense. Companies are treating different things in a different manner, and that is a big challenge. And I think what the standard does is it brings a basic comparability to the center stage, right? Having said that, I think there are few nuances as Mr. Chopra was saying earlier, which still needs to be addressed. One such thing that comes to my mind is the whole foreign exchange that is getting into the operating margins or operating profit, right? And if you look at companies like us, and there are many of them in the market who gives operating margin guidance. If foreign exchange fluctuations, gets accounted as operating margin or operating expense, it would be very difficult for companies to, to stand up and give a guidance, or it may get more and more difficult, right? And while one side we are trying to be investor friendly, if that becomes a challenge, companies may end up relooking at some of those, or in higher flexibility in the operating margin band that they end up doing. So it becomes very difficult for companies from that perspective to give guidance on that aspect. Coming to the other aspect of the exposure draft, I think what IASB is proposing right now is having subtotals in three aspects, which is operating profit, profit before financial and income taxes, and considering profit and income taxes with integral and joint ventures. I think all of that are again good ways of looking at it, because in a way your P&L and cash flow will significantly get aligned from that perspective. So those subtotals will help comparing what's the cash flow that you're generating from the operating activities, what the cash flow you're generating vis-a-vis the profit and loss from the investment segment, and compare the two. So I think that structure would help, but there are certain nuances that needs to be addressed across.
So thank you, Jayesh. And again, Nick has noted your concern on the foreign exchange, and I'm sure he'll respond to it. Coming to you, Ramnan, first of all, I would like to express our sincere thanks and gratitude for making it to the panel. I would like to ask a question similar to what I have asked Jayesh, that from a preparer's perspective, what's your take on these proposals as far as presenting the subtotals and the categories are concerned?
Yeah, I think first and foremost, greetings to all, Sanjeev, including you, and thanks for kind of having me on this. So I think in terms of, I more or less agree with the views expressed by Mr. Chopra and Jayesh. Because if I look at it, in the past, we've kind of only seen more changes that have come on the regulatory compliance landscape, right? Which are more about improving governance standards. But we never kind of kept much pace with bringing in more transparency and clarity on the performance information that really goes into financial statements. And I think to that extent, this exposures graph is a great step forward, and it will benefit companies, especially the ones with global footprint. And yes, it does have some challenges of certain definitions that have to be given in, as they've kind of added. I mean, to that list, I would also see things around government grants and other stuff being more clearly defined in terms of inclusion and other things.
Sure. So thank you very much. I'm sure again, Nick has noted the concern on the need for a clarity on the government grant. Coming back to you, Amarjit Chopra sir, the question, and in fact you mentioned that in your opening remarks regarding the cash flows, the operating, investing and the financial categories titles are the same as those in IAS 7 statement of cash flows. And I know that when we were converging under your leadership of NACAS, Chairman, in Ind AS 7, we have reduced the options, we have done the curtailment of option, particularly with respect to interest and dividend paid or received. Now, the IASB proposal in the new IFRS also contains some specific definitions. How different are these from IAS 7? And is there a possibility that an item can fall under different category under the new IFRS as compared to IAS 7 definition? If you can have your views, sir, on this.
I think, Sanjeev, again, this is one of the major challenges that you are going to face. If you ask me, so far as the definitions are concerned, if you get into the wordings are almost different. These are quite different from each other. Now, even in respect of the operating activity, as I said earlier, whereas IAS 7 may talk about the main business activity, it may talk of the principal revenue generating activity. This draft exposure talks about the main business activity. I think, to me, there could be a difference between the main business activity and the principal revenue generating activity in certain cases. And I think that can definitely cause problems, and that can really lead to differences of, you can say, the interpretations in certain cases. Similarly, when I go to the investing activity, basically you can think of it in the entire definition given under this exposure draft. We have absolutely no reference to the long-term assets, investment in the long-term assets, or the other than those which are in the cash or cash equivalents for that matter. Whereas in the earlier definition, the emphasis has been more on that particular side. This virtually talks of which the investments that we have made, or it also talks of the investments individually or with regard to the resources which are held by the organization in the other resources. So I think there could be some kind of a difference in the interpretations. And when you come to the financing activity, there is absolutely no reference to the expansion of the capital here. Whereas if you look at the cash, the IAS 8, in that IAS 7, that very, very clearly talks about even the capital infusion in the organization. And to me, the one point that you have raised, and I think it has been discussed earlier by Nick himself, when you are talking of a bank, you are talking of an NBFC. In that particular case, whatever funds are being invested, whatever income is being received, basically, that should be treated as a part of my operating activity. Why should it be treated as a part of the finance activity? To my mind, there is no reason that you should be giving an option in the case of the NBFCs or in the case of the banks to treat it either as a financing activity or as an operating activity. To me, in the case of banks, I am going to borrow for the purpose of the business and I am going to lend for the purpose of the business. Whatever income I am going to drive, that is going to be my operating profit, and whatever I am going to expend on that, that's going to be my operating expense. So I think in the case of the NBFCs or in the case of the organization like banks, there is no a rationale of giving any kind of you can say the choices. I think that choice needs to be curtailed, that choice needs to be taken away. Otherwise, again, the comparability problems will arise. Some of the managements will say that this is a part of my financing activity. Some of the managements will say that this is a part of my operating activity. So if at all we are improving a particular statement, we should improve that particular statement in a manner that there is absolutely no choice left to anybody. So flexibility might be good, but if the flexibility can lead to incomparability, I think that flexibility need not be given.
Right, so thank you. And I saw that, Nick was again taking a note, and I'm sure that he will come back with the necessary clarifications to the extent possible. Ramnan, this time I would like to ask you a question first before I ask a question to Jayesh. This is on the goodwill presentation of the balance sheet. The proposal is to present goodwill on the face of the balance sheet as a separate line item from the other intangible asset. Now, goodwill is an intangible asset only. So, do you see the merits in goodwill being shown as a separate line item? What would be the pros and cons of this?
Yeah, so I think in my view, when we look at it, we do see many companies that disclose goodwill on the face of the balance sheet, right? And distinguish the same from other intangible assets. And I think the change that we are kind of suggesting now brings in some amount of consistency and disclosure. But I think the clear distinction which remains in my mind is one, I think goodwill are generally recognized on a business combination, right? And if I look at in context of my own group of business, intangible assets are kind of more like product development cost, intellectual property trademarks. Those are the pieces that are being kind of recognized on a balance sheet on a going basis. So I think somewhere this distinction is there for us today. And depending on what it comes out, we need to kind of see whether we need to kind of bring in that consistency or not.
Thank you. Jayesh, moving to you. So while the main part of the definition of the operating category indicates that it is to be from the main business activities, do you think it will also act as a residual category? That is, if something cannot be put into investing or financing, that will also come here. Do you see it as an omnibus type of a category? What's your view on this, or what's your interpretation on this?
Yeah, I think I agree with that. Keeping operating expenses as a residual category is going to be a challenge, maybe a big challenge, right? As you could imagine, operating expenses would be the largest item of cost or revenue, on every financial statements, right? And the way currently it is being proposed is defining investing and financing activities, but operating activities is largely kept as residual activities. Right. In my mind, companies can have several transactions which are not directly linked with investing or financing activities or definition of investing and financing, and therefore may become operating activities, by the definition of the standard. Some example that comes to my mind immediately is, for instance, subleasing income or interest on tax refunds, right? Or, impairment losses on account of classification as assets held for sale. And there would be many more of these. The question is, are all of these going to be operating? I think the obvious answer is no, they are not directly relating to the operation of the business, and they should not be classified as operating activities. But if they end up doing, then the whole intent of having the financials as comparable is lost. So I think there is a merit in having some sort of definition of what should go into operating activity or operating expenses, and how do we treat some of these which don't fall into either of these three categories. Where should they end up going? So that's my view. I think keeping operating activities as a residual may become an omnibus and may defeat the whole purpose of this whole exercise to some extent.
Yeah, so that's I think that's very, very important, and we need to see that this should not be made residual, because operating is the main crux. P&L talks about the financial performance, so operating should not be residual if that interpretation is right. But I'm sure that we'll also hear from the IASB once I'm through with the questions, because we have time for Nick or the IASB staff to respond before we take up the poll, and then we'll be coming back to all of you with the poll results also. My next question is to Amarjit Chopra, sir. So this pertains to the classification of the associates and JVs. How do you perceive the identification of each associate and JV into integral and non-integral category for the purpose of new presentation requirement of statement of P&L? And is this similar to because in our accounting standard 11, we still have a concept of integral and non-integral. Do you think it corresponds to that?
Very frankly, Sanjeev, it's not going to be easy. I am being very honest about it, because you see, if I look at the definitions, the way these have been defined in AS 11 and the way this is sought to be defined here, I find quite a bit of a difference. Because when I look at this particular exposure draft here, it will be more of interdependency between the reporting and enterprise and of course the JVs or the associates. And this can even be used for the purpose of a brand. If a particular enterprise has given its brand to one of its associates or JVs, and if public perception can be that probably the business is being carried on in a same manner of the same product, it could still be considered to be a part of the integral part. And also one of the very important factors here is that suppose you have got a JV or you have got an associate in which probably, if at all you want to discontinue with that, in that particular case, there could be a substantial disruption in your own business activity. That could be an integral operation for that matter. But whereas if you look at AS 11 talks of number one, that wherever you treat it as your extension of arm. If you look at the case of the banks, if you ask me, which have got the foreign operations, the Reserve Bank of India has been saying that whether it is an integral or a non-integral operation. And there, most of the cases, we have been very, very clear that if you ask me that if at all tomorrow a bank of foreign operation of a particular bank suffers, ultimately it is the bank which is going to bear the entire brunt of the attack, basically. But there also it could have been treated as a non-integral operation. Now, if I look at AS 11 talks of that even if you have the control, there could be still an autonomy of the operations to that particular enterprise, and it could be considered to be a non-integral operation, because there more than integral operation being defined, it is the indicator, what could be the indicators for the non-integral operations. It also says that if the proportion of the foreign operations are insignificant, in that particular case, it could be considered to be a non-integral operation. If everything is being settled in the local currency there, all the payments are being made in the local currency there, and all the regulatory requirements are being met there, in that particular case also it could be considered to be a non-integral operation. And if at all, it says if the reporting enterprise is insulated from the enterprise cash flow. So one is purely for the foreign operations. But whereas the JVs and the associates may not be your foreign operations, let's be very clear about it. In certain cases, these could be foreign operations. In certain cases, it could not be foreign operations. Here, the most important angle for being integral is whether you are interdependent or not. it is not going to be even the control part thereof. Even if you have just given a brand and still it could be considered to be a part of your integral operation, I think this is going to lead to some kind of a subjectivity. What is my integral operation? What is not my integral operation? One may say, no, probably there could be sufficient indicators, there could be sufficient principles which might be laid down in the commentaries that what are going to be my integral operations. But yes, one particular part which may be similar to what has been given in AS11 is that if my proportion of the operations is significantly large there and significantly large here, and I am interdependent upon that, and if any disconnection there between the two can lead to disruption of the business activity in the case of a reporting enterprise, then it becomes an integral operation. So to that particular extent, probably it might be fine, but I think AS11 and this particular exposure may not be absolutely comparable. It may not be exactly comparable in that particular sense.
Right, sir. So thanks for this perspective. And Ramanan, before I come to you, I'd like to share with IASB that as far as the goodwill presentation is concerned, our division 2 to schedule 3 already requires a separate presentation of goodwill. So these proposals are in line with that. So Ramanan, my question to you, and in fact, this is a question, last question from my side to all the panelists of this first panel. But this last question would not mean that we'll close the panel. There is still more to go in the panel. This is on the unusual income and expense disclosure. So what's your view on this? We already have the concept of exceptional item and extraordinary item under the accounting standards. Then we have the concept of exceptional items under Ind AS, which are equivalent to the IFRS, more or less, with some carve-outs and some curtailment of option. And now this term, unusual income and expenses, is being proposed. And this relates to the occurrence in future. And this does not relate to the past occurrence. So what's your view on this? I mean, there is a significant amount of difference which will be created from the way we classify exceptional items. Or do you think it's going to be business as usual and there'll be no change?
So I kind of look at this is just increasing the complexity to a certain extent because we've got different definitions coming in. So surely in my mind, if you ask me, there is room for us to kind of standardize some of these definitions and simplify, because otherwise it's going to be open to a lot of interpretation, and each preparer of financial statements is going to probably look at it a little differently, because the situation changes from company to company, right? So somewhere I think it is important for us to see how do we kind of bridge that gap and simplify these definitions further.
Thank you. Jayesh, I would like to ask the same question from you also. What's your view on this unusual item?
I echo what Ramanan said to a large extent, right? We already have items which are extraordinary, exceptional items, and now we talk about unusual items. Without a very clear definition, everybody is going to use it, or interpret it the way they want, and that may not be again the best intent that IASB wants. So maybe it'll help putting a definition or aligning all the definitions there.
And before I ask this question to Chopra sir, during this COVID-19, some of the expenses were classified as exceptional item because of the immediate occurrence which is there. But now if we give it only a futuristic perspective, not a past perspective, probably it may be an entirely different flavor. So question to you, Amarjit Chopra sir. The question is same. I just added this COVID-19 situation also.
I can understand, yes. Sanjeev, what you have put. You see, to me, this entire talk of unusual income or unusual expenses is increasing the complexities, as Ramanan has said. We have the concept of the exceptional items. We have the concept of the extraordinary items. The extraordinary item itself is something which does not happen on a frequent intervals in the future in any case, and it has no relationship to the business activity for that matter. And even if I look at some of the examples which have been given actually in the exposure draft, like fire, etc., no, fire is not likely to recur, and it should not recur in any of the businesses. That's more of an extraordinary item rather than being an unusual item. And why should we prescribe for something, and why should we ask somebody to be predictive that whether it is going to happen in future or it is not going to happen in future? Basically, there's no point. I don't think we as accountants are going to predict something. We as an accountants, we should remain with the accountants for that matter. I don't think we can forecast the things, whether a fire would occur, a flood will take place or will not take place, or a war will take place or will not take place. I don't think that's the role of the accountant in any case. So I personally feel we should continue. And what is exceptional item? No, exceptional item might also occur after 5 years. I will give one example. No, if I enter into a wage agreement with one of with my people today, no, that because of that wage agreement, I am giving the areas in this particular year, and this may not happen for next 5 years, for that matter. No, I will say that this is not this is an unusual. No, I don't think it is an unusual item. It's very much an operating item which will occur. It is bound to occur after 3 years or 4 or 5 years. And what will be the definition of the several years? Whether it is 1 year or it is 2 years or it is 3 years. Some managements will say that it is 2 years. Some managements will say it is 3 years. Some managements will say it is 5 years. This concept of several years, I think, is totally misplaced. I think we are living with a particular kind of a definition, and we can live with that kind of a definition. That's the way I look at it. And you have raised the COVID issue. I think a very, very valid issue today. No, COVID-19 impact may not be only for 1 year. Let's be very clear about it. Whatever has happened in COVID, it may have its impact for the next 3 years, even in some of the industries, for that matter. No, if whether you will say that it is not an unusual thing. I think there cannot be anything more unusual than COVID-19, for that matter, if you really ask me. But then if I say that it will occur in the second year also, it will occur in the third year also, should I take it out of these unusual items? I don't think that's the way the unusual item can be defined. I personally feel we should look at it more from the exceptional side or more from the extraordinary angle side. And if at all those definitions are already there, well settled, I think let it be. And if we want to clarify something more on that, if we want to bring in more examples on that, we can provide more guidance on that. Let's provide more guidance rather than confusing the people with more predictive things in the future. That's the way I will look at it.
Thank you very much, sir. I still have 3 more minutes. I mean, to my allotted time for asking the questions. So I also have to keep time, sir. A quick question to all.
You are asking like an examiner. 5 minutes to go, 3 minutes to go, 2 minutes to go.
No.
The students get nervous, and the students are getting more and more nervous.
My panelists are such that they cannot be nervous. So what I'm saying is I have an opportunity to ask one more question, and and we can start in any order. Do you think that this one size fits all of subtotal and categories in the proposed IFRS standard will be good enough? Is this approach desirable? A quick answer from Ramnan, followed by Jayesh and followed by Chopaji.
Yeah, I think the concept of bringing subtotals as part of the exposure draft that we just spoke about, I think the concept is good. In my mind, it is important to kind of bring in some of the definitions clearly, because sometimes what could be an financing activity for a business could probably be a main business activity because of the nature of business that the company could be in. I think it is important to kind of bring out those kind of nuances, especially for non-banking financial companies and stuff like that. But largely, my feel is the subtotal will bring in a lot more consistency in the disclosure for the companies, especially within the same industry. And that is going to be a big joy for the investor community in a big way.
Thank you, Ramnan. Over to you, Jayesh.
Yeah, I also echo that pretty much to a large extent. I think it's a right intent, right decision in the right step or a step in the right direction. But to some extent, more work is required to define or to put some nuances in place so that the intention is achieved. Right? We talked about some of these, and I'm sure every industry will have their own nuances. So we need to figure out how do we deal with that to ensure that there is the intended uniformity in reporting is achieved. Otherwise, the companies will end up doing numerous management performance measures or non-GAAP measures, and the whole intent will get distorted. So I think, again, the three-step measure is a right step in the right direction. But we need to do some more in fine-tuning the definitions, and most importantly, the operating expenses definition, to be defined so that non-operating expenses do not get in there and distort the whole operating margins.
Right. Thanks, Jayesh. Sir, Amarjit Chopra, sir, what's your view on this?
I will only like to echo whatever sentiments have been given by Ramananji and Jayesh. I also feel that it's an effort. There's no doubt about it. It's an attempt to create one size which fits all. But I think then there are issues which we have already discussed, whether this is of unusual item or this is with regard to particularly your operating activities becoming the residuary activity for that particular matter. The options being given in the case of the NBFCs and the banks, I think those options have to go away. There is no way, because if you want to really make it comparable, in that particular case, the options have no choice. There is no scope for the choices for that matter. So I personally feel it's a good effort. There's no doubt about it. But I think this good efforts needs to be still refined further, to the extent that it has been discussed here today also, and probably it might have been discussed and the comments might be received over this in the times to come. There's no doubt about it. And I think when it comes to even integral, non-integral, what kind of definition, what kind of, I think tight compartments can be given with regard thereto, one will have to think of. Otherwise, one could create certain kind of operations and one could treat them as to be integral and some of the operations to be non-integral. And then probably that tendency might change over the period of time. So or I think the treatment could also change along with that. So to my mind, there needs to be a very, very clear-cut principle on that. You see, earlier standard has been based upon very high principles. So principles led to some kind of subjectivity. We have reached this particular stage. Even if we have to make it a little bit rule-based, let's make it rule-based, but then let's leave any scope for incomparability in the periods to come.
Thank you, sir. So, Nick and Sue, you can see that these efforts of IASB have been appreciated by all the panelists, and they have flagged many issues. And probably this is a new era where we are giving our comments, not after the standard is issued. We are discussing openly the issues which we see in the proposed standard. So, I would like Sue or Nick, if you would like to share some comments on the views expressed by the panelists.
And before that, Sanjeev, I will like to thank everyone and thank you, thank Vijay and the entire institute for providing this opportunity. And I will wish everyone that everyone keeps safe and stay safe.
So thank you very much, but we are requesting to stay on because we'll be doing a poll. Around maybe 10 minutes more, if all the three panelists can stay. We would like to discuss the results of the poll with all three of you, sir.
Okay.
Sanjeev, apologies, but I have an investor conference at 5:30, so I will.
Sure, no, I understand. I'm aware of.
So similarly, I have the disciplinary committee meeting. Sure. I have the disciplinary committee meeting actually.
Fine, sir. No, absolutely fine. We understand that, sir. Okay. So can I request Sue or Nick, in whatever order you want to take? Would you like to express some views, IASB views?
Nick will start and then I'll come in at the end.
Sure.
Perfect. Thanks for that, Sue. And thanks to all the panelists for your insightful comments. It's very helpful for us to understand the issues you face. And thanks for the opportunity to respond to some of them. So I've made some notes here. I mean, showed if there's something that I missed that you have a burning question on still, if anything. But a lot of the debate seemed to focus on this residual definition that we have for the operating. And I think it's maybe worth just reiterating that the purpose is to get more comparability rather than diversity, and that residual definition also takes a view that if you do something in your business, and it's not financing or investing, it really is part of your operations, and so by having it as that residual and capturing more items, it does so for all entities equally, making that more comparable. So these judgments about what is, we hear sometimes core and non-core distinction, operating, non-operating, these kinds of distinctions end up in more diversity. Now, the other thing is that we do need residual definition to some extent, somewhere within this structure to make sure we capture a complete picture of all the income and expenses. You wouldn't want a situation where something just doesn't fit any of the definitions. And so rather than create a separate category, once again, the board concluded that to get that comparability, it made more sense to make that the operating category to again get that comparability across how this is viewed from entity to entity. Now, some of the examples, such as commission, for example, again, that would likely come into your operating activities, but again, similarly from entity to entity, making that a comparable across. I think there was a comment made about foreign exchange, and you'll be aware we didn't talk about this in the presentation, but the proposals require that the foreign exchange be allocated to the categories to which it relates, and the thinking behind that is to get a faithful representation of what each of those categories represent. So, for example, if you have foreign exchange on your operating activities, to get a complete picture of those operating activities, it needs to include those expenses that have come from the foreign exchange. And so this is very much the view that has been taken. Now, within that structure, it's important to maybe remember that the ability to create other subtotals, which are useful, which is in IS1 today, has been retained. And so to some extent within operating profit, if there are useful subtotals, provided they continue to meet the structure, could be used to communicate some of these same messages. And then, as was mentioned, and we'll come on to what possible, the management performance measures are there. And so these proposals very much act as a package to try and capture that aspect while maintaining comparability in the statement of profit and loss itself. Another comment was made about the optionality for the financing, and just to clarify about this, business activities, the main business activities, is only relevant for this moving of expenses from the financing or from the investing categories into operating. And the reason we have as a policy choice there is to capture those entities where they may have, we refer to sometimes as conglomerates, which may have, for example, a manufacturing, and we see this often in the auto industry. You have a car manufacturing, but also a financing entity within. And so you have two main business activities, your manufacturing and your financing. And it wouldn't make sense in that scenario to bring all of your financing expenses into the operating when a good portion of that relates to the manufacturing part of the business, not the providing financing part of the business. And so to accommodate, this is really the point. Now, having made it a policy choice, we appreciate that opens up the option for those entities that are purely financing, such as banks, to try and find some kind of a split as well. In our outreach so far, we've found that most, if not all, of these types of entities are looking to take the choice to put all of the financing in, and that's because that's how they look at their business. This is the main crux of why this part of the proposals came in, was to be able to move those up. And so I just wanted to give a bit of the background behind that. It's really meant to lead to a more accurate picture for those entities that do more than one activity and rather than to drive diversity. Government grants was specifically mentioned, and I think, again, there's nothing specific in the exposure draft to government grants, but I think with this, it would be important, as with foreign exchange, for example, to look at what the purpose of those grants are and what are the expenses or the income that it is addressing, and equally to get that same categorization would be the likely result following the proposals. The last point I think I wanted to make a comment on was about the integral and non-integral. I think there was some good discussion there, and I'm afraid I'm not familiar with the FX separation that you have in local GAAP, but I would like to highlight that the definition really focuses on this investing definition. And as I mentioned, what we're trying to identify is those entities that meet that investing definition, so are generating a return individually and independently. And then those additional indicators have been given to try and help to make that judgment. And we're certainly very open and would love to hear feedback on whether there are additional ones that sort of help to make that distinction clearer. We have heard feedback that there is certainly judgment involved. Some of those are easier for some entities than for others. And to the extent that entities look at it this way, it's helpful to understand, to get feedback on where that might be able to be made clearer, to get that distinction maybe a little bit more concrete. And then last, I will just touch briefly to say about unusual items. We're going to touch on that in the next section. So we're going to talk a lot about the reasons for the unusual, but it sounds like you have some local definitions that we may be able to take some help from. But when we look globally, we know that unusual is sort of looked at quite diversely currently, and so really trying to get a bit more a definition around that is trying to get more consistency by having a single way of looking at it across entities. But we'll come more onto that, and we'll get into more depth than unusual when we talk about disaggregations as one of the key proposals. So I'll stop there and ask Sue if she has anything further to add.
Maybe just a couple of quick things, not so much answering questions, but maybe to leave you with a few thoughts for your letters that I'm guessing you're going to compile to send in to us later on. As Sanjeev said, this is a new era where we are lucky enough to have your input during the development of our standards, and I think that's a great opportunity to have your thoughts. Just a couple of things I wanted to touch on. The first was operating as a residual. And Mr. Chopra gave the example early on about a steel manufacturer who may have some commission income, which would seem to end up in operating. And I think that's the correct reading of the proposals. And that's sort of by design. And I just wanted to give a little bit of colour on that because it comes up quite a lot in the outreach. So I think a number of people who pick up the exposure draft like the idea of an operating subtotal and an investing section and a financing section, but some people would prefer that the operating profit section captures what they would see as a sort of the core business or the main activities of an entity. And I understand that view, but I guess the board talked about that quite a lot. And the reason why we landed where we did is because we felt that it was more likely that we'd be able to get a common understanding of what financing and investing meant, which meant that we would have a greater chance of consistency within operating. It does mean that operating then incorporates the results from your sort of main operations plus other things to the example given. But then we were thinking that we would rely on disaggregation and the potential use of subtotals within operating to potentially address that. So I guess if you were to write back to us and say we think operating should be defined as core or main business activities, I think we would have a reservation about how practical it would be for us to come up with a definition that everybody would agree on. So if you could think about that in your responses, I think that would be really helpful for us. The other thing that was mentioned again was integral and non-integral and the sort of complexity and potential lack of clarity and consistency of application of those proposed definitions. Again, that's something the board talked about quite a lot. Personally, it was an issue that I raised at the board table, so I'm on your wavelength. And it is something we've heard a lot about during the outreach. People wonder if there's enough guidance for people to be clear what is integral and what's not integral. And some people would draw the line in a slightly different way. So I guess on that, when you're responding to us, we'd be interested in any suggestions you've got for how it could be more clear. But I guess more fundamentally, the thing I certainly would be interested in when I'm reading comment letters would be, do you think we even need a distinction between integral and non-integral at all? Because obviously if we didn't need to have that distinction, that complexity would go away. So some investors told us they liked the distinction, but it wasn't a unanimous view. I would love to hear when you come back to us what your thoughts are as preparers on, is it worth the trouble of making that distinction in the first instance before we get on to how we could make that distinction. And I'll leave it at that. But just a couple of thoughts for your feedback later on.
So thank you very much, and we will certainly be giving examples from our accounting standard 11, which talks about the indicator for the integral and non-integral operations. And Nick, to your point on whether we have a definition for exceptional item in the local GAAP, yes, we do have, but I was also referring to the IAS 8 also, the way it deals with the exceptional items, and also in one of the educational material, we have made an attempt to define exceptional items, so we can certainly send you that. So thank you very much, Sue and Nick, for that. It's time for the poll now. I would request Yagneshji or whosoever is administering it to kindly display the poll.
I think it's Devang, the IT.
Devang, can we request you for the poll? Please
IT
display
support,
the poll.
IT support team.
Yeah, and we would request the participants to answer the question which is reflected on the poll.
So we implore all the participants to take part in the poll. And be heard and get noticed.
Devang, please display at least. I am not able to see the poll.
Devang, please.
You are also not able to see it.
Devang, please put the questions and then invite them to answer the questions. That's it.
No, this is the answer has been displayed. So probably to the panelists, there was no option to give answers. Okay, so in the first question, that which of the proposed subtotal would provide useful information to users? So A was 38%, B was 51%. And then do you think the proposed distinction between integral and non-integral associate and joint venture would provide information to users? A was 71%, B is that. But honestly, I don't know what were the answers, A, B, and C. So I would not like to comment. So unless Yagnesh or anyone from the IASB staff, if you would like to say anything on this.
I think
I will like to log off.
Sure, sir. Thank you very much. And thanks to you, sir. Thanks to Jayesh and Ramnan. I know that they already left.
Thanks everyone, and best wishes to everyone. Solid. All my best wishes. And Nick.
Bye, sir. Bye.
Bye.
Thank you very much, sir.
Thank you very much.
Thank you. Bye-bye.
Thank you.
Devang, can you please display the answers option? Devang, can you please display the options given in the question, please? Yes.
Yeah, here it is. So in your view, which of the proposed subtotals would provide useful information to users? Operating profit was A, operating profit and income and expenses from integral associate and joint venture, and third was profit before financing and income tax. So the least yes were for the third option. And do you think the proposed distinction between integral and non-integral will help? Majority answer was yes. So when Sue was saying that people have said that whether it will be useful or not, but here in India, people are saying it will be useful, probably also because of the fact that in accounting standard 11 in local GAAP, we have the concept of integral and non-integral. So thank you very much. With this, we come to the end of the first panel, and in exactly 1 minute from now, we'll start the second panel. The scheduled time is 5:45 p.m. for the second panel. So just take a 1 minute break and we'll be back again.
Sanjeevji, it was a very enriching and well orchestrated. Devang, can you allow the video of mine, please? Devang, can you allow the video of mine, please? Hello, Devang. You should allow. It says that your video has been stopped. It says your video has been stopped. Yeah. Okay, sir. Yes, thank you. Sir, it was indeed a very good and well orchestrated session, Dr. Sanjeevji. And those who joined later, I welcome to them. And it was a very interesting and absorbing session. But Anik, your illustrations indeed help a lot in making some clarification and help comprehend what we all have been hearing about. And here is the breaking news, guys and friends. And this breaking news is from none other than Nikita Bothra, who has shared some very interesting statistics. And that is, we have about 1,400 plus viewers from India, UK, USA, Dubai, Nepal, Philippines, Hong Kong. So we got 1,400 participants from the globe, and it's very interesting. And the next panel will be comprised of along with the Nick. Hello, someone's.
May I request that those who are not speaking to kindly put it on mute.
Please mute, please. Yeah. Thank you so much. Thank you, Sanjeevji. And in this panel number 2 discussion, we have along with Dr. Sanjeev Singhal and Nick Balo, Mr. Kedar Upadhyay. He is the CA for the CIPLA. And thereafter, Mr. V. Ramakrishnan, CA for TCS. And our accounting standard board, my co-opted member, CA Sudhir Soniji from SI Batlio Network ENY India. And this is again going to be a very, very interesting and mind-absorbing discussion because as Sanjeevji has hinted, we have heard about the extraordinary income, which is not a part of the IASB, but we have exceptional income. And now you'll see what are the unusual income and unusual expenses. However, he has hinted to some extent, but now we'll see in great threadbare in detail about what are the unusual income and unusual expenses. Dr. Sanjeevji, it's over to you now for the panel number 2. Very interesting panel. Very interesting.
Thank you very much. Thank you, Yagnesh. And this brings us to the second panel on the exposure draft proposals on disaggregation. And I would once again request all the panelists to put your mics on mute and please unmute when you're speaking. So in this panel, the structure of the panel will be that after the introduction of the panelists, I'll be requesting Mr. Nick for a brief presentation on the subject. And then there's going to be a few questions from the panelists, which will again be followed by the responses or the views from the IASB, including Sue Lloyd and the IASB staff. And then we'll be doing another poll and discussing the results. So thank you very much to all the three esteemed panelists for joining this second panel. Jigar, can you keep yourself on mute? Jigar, can you keep yourself on mute? I would request the ASB staff to please call up Jigar and ask him to be on mute. Requesting the ICL staff to call up Jigar and put it on mute. Okay. So thank you very much. So for this panel, we have three esteemed panelists. Kedar Upadhyay. Kedar is the global CFO at CIPLA since August 2016. Previously, he was the Vice President of Global Generics Finance and Head of Investor Relations, Director of Corporate Finance and Investor Relations at Dr. Reddy Laboratory, and a Finance Executive at the PepsiCo. He's also a cost accountant and a follow-on MBA from IIM Bangalore. Kedar, we welcome you to the second panel, and we really thank you for taking out time today evening with us. Then we have CA V. Ramakrishnan, who is the CFO of the Tata Consultancy Services. He was appointed as a CFO in February 17. He has over 35 years of experience in various aspects of finance, including management of financial operation, governance, compliance, and internal controls. He has led external assessment of other Tata Group companies under the Tata Business Excellence model and was recognized as Star Assessor 3 years in a row. Earlier, he was the head of TCS North America's finance function for over 7 years. And prior to joining TCS in 1999, he was the head of finance and company secretary of Tata Elxsi Limited. He is a commerce graduate from the Laila College, Chennai, and he holds the degrees from all the three professional institutes, CACS and ICWA. We welcome you, sir, to the panel, and we are really thankful for taking out time. Our third panelist is an auditor, Sudhir Soni. He's a partner, assurance service at SR Bartleby network firms in India. His experience of more than 25 years, and he has been a Shield panel member for many years. He's been a co-opted member and a special invitee on Accounting Standard Board for almost a decade now. He has also been a special invitee on the Ind AS Implementation Committee and delivered various lectures across the length and breadth of the country for the Institute of Chartered Accountant of India. He is the auditor of many leading companies. We welcome you to this panel, and thanks for taking out the time. So before I start with the panelists, I would request Nick from the IASB to give a brief presentation on the subject under discussion. Over to you, Nick.
Great, thank you. As we wait for the slides to come up here. Perfect. So disaggregation, so we've talked about unusual a little bit, and we'll get a bit more into that, but it's not the sole proposal here. If we move to the next slide, we can see that the message the board heard was really about getting better information in the financial statements, and not necessarily simply more disaggregation or less disaggregation, but really better information. And so the board's come at this from a number of ways. And so there's a number of proposals to try and address this for different aspects of how we can get better information. I'll start with what we call general proposals, which are more principles-based set of guidance to help preparers. Then talk about the analysis of expenses and this by nature or by function distinction, and then we'll get on to the unusual, which we've touched on a little bit already. So if we move to the next slide. When I talk about the general proposals or principles-based proposals, we've got here a set of proposals, first talking around the roles of the primary financial statements and those of the notes. And this is really to give some high-level guidance around making those decisions about what's the level of aggregation or disaggregation that would be most appropriate on what many refer to as the face of those statements of profit and loss and balance sheet, for example, and the level of detail that might be appropriate in the notes, and a little bit of guidance about how to make those decisions. Complementing that, we've introduced some principles around aggregating and disaggregating the individual line items. So introducing the concept of looking at the characteristics of those line items, aggregating those that have similar characteristics and disaggregating those that have dissimilar characteristics, along with a three-step process to think about making those decisions in the financial statement preparation process. And then additionally, there's some guidance around avoiding non-descriptive labels such as other, not banning them, but providing more guidance about how to best avoid their use to get more descriptive labels. And when that's not possible, to give more disclosure potentially in the notes to give more transparency to those types of items. If we move to the next slide, we'll talk about the analysis of operating expenses. And so, as we know, there's the by nature method of expenses, which we saw in the first panel in the example that we provided, showing the inputs such as raw materials, employee benefits, depreciation as the individual line items versus the function of expense method, allocating those to functions in the business such as cost of sales, administration, research and development. So what the board is proposing here is that this distinction or this presentation of expenses by operating or by nature or by function would be based on that provides the most useful information. So it would not be a free choice. The board's proposed some principles around deciding which provides the most useful information. An entity would then present either by nature or by function, meaning that it would no longer be a mix. There is, of course, an exception for minimum line items that may conflict with the most useful presentation. Those minimum line items would still be required. Outside of that, a mix would not be permitted. And the reason behind that is really trying to make sure that there's a complete set or a completeness in the line items that are presented. And so to illustrate that, if we looked at an example of an entity that presents by function and has a cost of sales line item, if they then went and presented a line item for depreciation, it would be unclear whether cost of sales was incomplete because all of the depreciation was in that depreciation line, or whether the depreciation line was incomplete because the depreciation that should have been allocated to the cost of sales is sitting in the depreciation line. And so what this proposal aims to do is to eliminate that by making it clear because it's only one or the other. Importantly, for those entities that then presented by function, an entity would be required to disclose in the notes the analysis of the operating expenses by nature. And now that's at an entity level, so not breaking down the individual functions, for example, cost of sales, but rather showing the at an entity level. And so we have an example on the next slide of what that might look like. And so in this example, we can see on the left side an entity presenting by functions. So we have a number of functions: cost of sales, selling, research and development, general and admin. And then we can see here how when there's a minimum line item, such as impairment on trade receivables, that line item is also presented coming to the subtotal. This entity would then present in the notes on the by nature analysis, which is demonstrated on the right side. And we can see again that inputs level distinction, the raw materials, employee benefits, etc. Now, one important item to note is that first one under revenue, the changes in inventories and finished goods. This highlights that this is the inputs and not necessarily the expenses that have hit the statement of profit and loss. And this changes in inventories would be what would capture those items that have been sort of effectively capitalized into the inventory for raw materials, for example. And so an entity wouldn't need to unpick that to be able to do this type of disclosure. So if we move to the next slide, this is about our unusual income and expenses. And so, like I said, we've talked a little bit about this already, but when going through developing these proposals, the board identified that many entities do identify, and indeed some of these types of labels, such as extraordinary, unusual, non-recurring, entities try to identify these items today. However, there's not a consistent way to look at what is unusual, and so there's a lot of diversity in what gets presented. When looking at it, the board zeroed in on why this information is being presented and what the value that it gives to users is. And it really focused on this, providing information about those items that have limited predictive value. So looking forward, what are those items that will not recur into the future? And so the definition that's provided to try and gain consistency is income and expenses that have limited predictive value. And they have that when it's reasonable to expect that those income and expenses that are similar in type and amount will not arise for several future reporting periods. And now there is a level of judgment, obviously, that would be incorporated in that, but all entities would be using the same definition when coming to those judgments. Also important to note here is that this is not a separation within the statement of profit and loss. This is a note disclosure that's being proposed. And the reason for that is to ensure that when the items of unusual are identified, along with that, the disclosure requirements to explain why they're unusual can be shown in the same place, along with a breakdown of which line items in the statement of profit and loss have been affected. And if an entity has the by nature note, that which of those items by nature have also been affected. And I think that's the last slide in the section. So having talked about those overall principles of disaggregation, the analysis of expenses by nature or by function, and now the unusual expenses, I'd like to turn it back to the panel to hear your views.
Thank you very much, Nick. And I would request the host to kindly take off these slides so that we can see the panelists. Thank you very much. So with this, now I move on to three of my esteemed panelists. And Kedar, I would like to start with you first. What's your view on the proposal relating to the disaggregation from a perspective of someone who is preparing the financial statements?
Thank you, Sanjeev, firstly, to you and the whole ICAI and ASB and IASB for having us here. I would speak as a practitioner and somebody who has interest in reading financial statements of various companies. First, I welcome this intent by the board to improve the communication. I am able to relate to the title of this whole program and project that they have, that better communication with the readers of the financial statements. So to that extent, I think the intent is very noble, and the way it's been converted to practice, the way it's been translated in terms of the exposure draft, I would think that we should take this as the first step, and the rich feedback through sessions like this that the board will get. I urge the board to make iterative changes so that the eventual output is not more consensus driven, but it's dictated by what's right for the readers of the financial statement. And I will make only one or two suggestions, and before I give it to my other co-panelists. One is that it will make sense to be a little more prescriptive. I know IASB and IFRS fundamentally is a very principle-based philosophy, so to say, and they should retain their flexibility. They should retain their approach of giving options to the preparers of financial statements. But in matters which are prone to significantly different kinds of practices, especially considering the fact that IASB is prevalent across multiple emerging markets, where the local regulations, the local contexts, the local economy and corporate world will have various diverse practices, it is going to be appropriate to be a little more prescriptive than what it is now. So that's my first comment. And second comment is in terms of disaggregation and in terms of the other topic, which is the unusual item which we are going to touch later. But in terms of disaggregation, I would go with what they have recommended. I would go back to my first point that in order for the practice of disaggregation to get more teeth, they should make certain rules and prescriptions. And I would actually go beyond operating expenses. It's in terms of revenue breakup, in terms of segment disclosure, there is a lot that one can do. And for example, just to give you an example from my industry, which is pharmaceutical, there are not too many companies which disclose their numbers into multiple segments. Typically, companies only have one segment, and the appreciation of volatility, appreciation of risk, appreciation of business model strength of various diverse businesses that exist within one corporate cannot be facilitated unless you have multiple segments. So I would just make that one comment and stop here, Sanjeev, that I think the board should go beyond expenses and they should be a little more prescriptive to set certain rules. Thank you.
Thank you very much, Kedar, for your perspective. And I saw Nick taking detailed notes of being a little more prescriptive, and we'll hear from you. We will be hearing from him when he takes up it. So, Mr. Ramakrishnan, the same question to you as well, that how do you see this disaggregation proposals from a preparer's perspective?
Yeah, I think I echo what Mr. Kedar had mentioned. Just reading through the exposure draft, I think the amount of detail as well as also the approach, I think is definitely in the very right direction. And as far as aggregation and disaggregation goes, by and large, what is being set out in the standard is already being followed. And I have several examples from our own financial statements and the industry that across assets, liabilities, as well as in the incomes and expenses, the level of aggregation and disaggregation is happening. So I would only differ a little bit with Kedar on the requirement to be more prescriptive. I think reading in more detail, I do get a feeling that a lot more prescription has happened already in terms of addressing different types of situations and examples. I have some comments on unusual expenses and incomes, which we will come to. But on aggregation and disaggregation, I don't have anything further to add, Sanjeev.
Thank you very much. And I hear two views. One is be a little more perspective. Second, it's fine. So Nick will be happy with that. Coming on to you, Sudeep, you've been an auditor all through your life. What's your take on this proposal? From the auditor's perspective, do you think this will be helpful? Do you think it will improve the audit quality? Or do you think it will improve the disclosure quality? What's your take on these?
Yeah, thanks, Sanjeev. And good evening to the dignitaries from ICI, IASB, and all the participants and my co-panelists. Really privileged to be here. I've been through this exposure draft, and I feel it's a significant step forward. And I would like to compliment the IASB. It seems to be in response to the requirement of the users. Firstly, the subtotals, and also including management performance measures. So I clearly believe that this is going to be a step change in the quality of financial reporting.
Thank you, Sudeep, for that brief and crisp answer. Let me now move to the unusual items. In fact, we briefly touched upon it in the first panel also. So in the accounting standards, we had this concept of exceptional item and extraordinary item. Then we moved it to only exceptional item under Ind AS, which is corresponding to IAS 1. Just that we did an additional attempt of defining an exceptional item in the educational material question on Ind AS. For the benefit of the international audience, we have the educational material where through the various FAQs, we try and help explain the various concepts and answer some questions. We also have ITFGs, which the Honorable Vice President mentioned in his opening address, which also further deals with those aspects. Now, Kedar, the prescription is for unusual items. Do you think it's going to be business as usual? Do you think it's going to be different? And do you think something more need to be defined if we are talking about the unusual items now?
Yeah. So Dr. Sanjeev and everybody on the call, the way the exposure draft has proposed to treat unusual items, I don't think it's going to be business as usual. I don't want to say it's going to be business as unusual, because that will be too much of a light-hearted comment. I hope Nick doesn't take an offense with it, but I am able to relate to what IASB is trying to do here. I think they are trying to bring uniformity across extremely divergent practices. What I would urge is, I would make 3 recommendations. First recommendation is like what you said, Dr. Sanjeev. The local definition of exceptional item is extremely advanced, and actually it considers all the eventualities to determine what is the recurring and sustainable level of earnings for an enterprise. See, any reader of the financial statement would want to know what is the sustainable level of earnings. I know the board has always taken a position that volatility in itself is not bad if it is dictated by business model. But what we need to consider is any stakeholder has a lot of stakes in sustainability and the recurring recurring revenue stream of the earnings for the enterprise. So in order for that to be facilitated, I think we have to visualize what all can be non-recurring and what all can be differing from the usual revenue stream and expense stream. So to that effect, what I feel is the definition of unusual item in the current exposure draft is a bit narrower. So my request is to make it a little wider, and the best is if it can be matched with what we have in India, which is an exceptional item. I don't propose we should go to extraordinary item, which all of us have discarded. But I think matching it with exceptional item would be a great outcome. That's my recommendation number 1. My number 2 recommendation is to enlist unusual item not in the notes to accounts. In my view, it has to be on the face of the financial statement. Because if you put it in the notes, in my view, it will take away the comparability of the financial statements. So it's not that every analyst goes through every note in great detail. And it's not that every reader refers to everything which is written in the note. Ideally, they should, because every preparer has spent enormous amount of time and has taken due care to drop the notes to accounts. But in practice, what most of us glance is the face of the financial statement. We look at the P&L, we look at the balance sheet, we look at the cash flow, and probably we move on because we are not as much either by virtue of time or bandwidth or whatever, we don't necessarily go into notes to accounts at all. So my view is we should have this whatever unusual item, exceptional item necessarily on the face of the financial statement, and maybe we should find a way out how to make it in a non-cluttered manner. That's my second recommendation. And thirdly, I would visualize that these unusual items could be ongoing. For example, the current ongoing crisis, we touched upon it in the previous panel to some extent. I think Corona is going to be there for the next 2-3 years. The after effects, nothing stops in 1 year. For example, a company has a large litigation claim in a sector like pharma. Many times there are large settlements, large litigation claims, large penalties. And sometimes those are part of the business model, but the quantum and magnitude is so high that sometimes there are after effects of this kind of charges. So I think the unusual items will be ongoing. So linking it to future predictive value or linking it to say that anything which has a limited predictive value should be unusual item probably will not gel because the items will have ongoing recurrence. And that's why my proposal is to dealing from this future predictability. I have those 3 recommendations. I mean, there are a few more comments, but I'll come back again. Thank you.
Sure. Thank you very much. And this particular point on the predictive value, as you rightly said, was discussed in the previous panel. Also, that it will be very, very difficult to make that kind of a prediction. I now move on to Sudhir for the same question. Sudhir, you have audited so many companies and you have come across many exceptional items. Do you think that this definition of unusual item gels with the meaning or the interpretation of the exceptional item which has been there? And do you agree with this proposal of IASB that it should be futuristic, should not be based on the past recurrences? What's your view?
Yeah, so I think, Sanjeev, if you see the guidance that is given by the IASB in para B15, things like reversal of inventories, litigation settlements, reversal of provisions, these have typically been interpreted to be exceptional items. Now, IASB has not described these as exceptional items, but they have required these to be disclosed separately. And then there is a separate requirement which is of this predictive nature of unusual items. I feel it is certainly useful from an investor perspective if you can give that, but clearly it will involve a very high degree of judgment, and that might make comparability again very difficult because the ability to predict whether an item will happen or not may be very easy in some cases and may be very difficult in some cases. As an auditor, I feel that it will be a very challenging area and involving very significant
Thanks, Sudhir. As an auditor, I also have the same feeling that there would be a challenge. While the management will prepare, they will also have this difficulty. From an auditor's perspective, how are we going to audit? Mr. Ramakrishnan, the same question is for you as well on the unusual item. What's your take on whether the local definition, local means the definition which we use in India for exceptional item is good, or this unusual item definition is good, and on this futuristic condition which is there? What's your view on this?
Yeah, I think I see it from an IFRS perspective. I think today, since there is no specific definition, the labels and nomenclatures vary depending on the preparer, and also like unusual, exceptional, one-time, etc. And also, in the absence of standards, it's also often not clear why the items have been identified as unusual. So, I think the standard making incomes and expenses as unusual, it makes it more transparent and comparable across entities. So I think it's a good move because today, since there is no specific guidance, so it is a little bit free. I'm talking a bit from an IFRS perspective. I agree with you that in Ind AS, I think there is quite a good definitions on exceptional. I would definitely urge, like other speakers have talked about, to take those into account as well as from the IASB. But I have a few comments, if you will permit, Sanjeevji, a little bit on
Absolutely.
the nuances. I think,
please go ahead.
I think Mr. Chopra said he implied that the devil is in the details. So I will just quickly touch upon a few of the things. I may take a little time, permit me. I think the first question in my mind is whether the information should be in the notes or in the statement of financial performance. I think the board has explained why it should be in the notes. I think the idea is to give a more complete description and analysis. I think that is fair, but I agree with Kedar that it may be a good idea to keep it in both, keep it on the face, because a vast number of users actually go into the financial statement and not really look at the notes. But in the face, you can't make it cluttered. So the notes should have more description, but have it in both the places. And the very fact that this is unusual is that on the face, it may not appear every year after year, right? But there is also one specific, and if you have it as the standard as talked about only in the notes, I think they should also specify that if there are no unusual items, report it. Because if users, rather than speculating, they can go, and because one of the objectives is to have one single place where the user can locate anything on unusual item. So in a given reporting period, if there are no unusual items, state that there are no unusual items. I think that is one. The second is there are a couple of suggestions on the reporting period itself. I think the para 100, it says basically the income and expenses have limited predictive value when it is reasonable to expect that income and expenses that are similar in type will not arise for several future annual reporting periods. So the issue is with several. So there can be two situations. One, I think it was already touched upon, the effect of, say, for instance, COVID. COVID is an unusual occurrence or event, and the effect of it could be more than 1 year, right? It could be in this year as well as perhaps next year and the following. So just because the effect will be there in the next 2 years or so, does it become less of an unusual item? So I think that is an issue. But more important, it does not address the issue whether if the reasonable expectation is that the event will occur maybe only once in the next few years, then will it get excluded because the definition says several, right? And the next one is on the para B70, read with para BC 136. It's basically, I think we talked about whether it's on basis of past occurrences. I think the standard says that it does not require entities to consider whether a similar income or expense has occurred in the past. And similarly, it also says that it is not necessary that the occurrence does not necessarily indicate that similar income or expense will occur in the future. So which is both are very good. But I think it will help if it makes out specifically that the absence of the same event in the past is not necessary a test for saying whether it is unusual in the current year or not. I think at the risk of being a little flippant, I will say that this will take away a lot of discussions between preparers and auditors, right? So that is one. And I think the other point is on BC 132. It is talking about there no specific period to be given. I think there are good reasons which have been set out. You don't want to say for all future reporting periods or a very short period, which is very fine. But the period, I think it was also mentioned by one of the other panelists, saying that, somebody could say 5 years, somebody could say 10 years, somebody could say, I have taken it on 3 years. Why not make it a little prescriptive here, like what Kedar is saying? At least the standard need not specify a period because that will be arbitrary. But it can say that in the para 101B, where you are giving out the explanation, let the period that you have considered also be included. So I think that will make it, then there will be at least the user will know that in arriving at this predictive value for the future, this company or this entity has used to say 5 years or 10 years or whatever it is. So, so this is one. And I think just one more point on the para B73. So this is on basically what it says is if the income or expense which has arisen, it's unusual. The related costs and income need not be shown as unusual unless they are by nature unusual. This is fine. But I think it is the note should permit the details. I see whether I think there is a good explanations given, but I think there is a little bit more clarity required because whether the company wants to show unusual items separately as a note or management performance, include it as part of the management performance measures, I think the entity should be asked to say that, look, because for instance, if there is a sale which is very unusual, and that is resulting in an unusual category reporting. But because of that revenue, there will be a significant impact on the profits, etc. So the profits by itself may not become unusual, but then you should be able to explain it very clearly. So I think a little bit more clarity around that will be good. And I think the last item is extraordinary items is anyway not there. But to take the inputs from exceptional items where we have in India is very useful. I hope a little long answer. I hope it's
no, that's fine. I really appreciate it. Sudhi, I would like to have your view on 2 points. First, on this mentioning of the unusual item on the face of it, just like we have exceptional item, we give a total and then the breakup is given in the notes in India, and this is for the benefit of the staff and Lloyd from IASB also. In India, we already disclose exceptional items on the face and then the breakup in the notes. Do you think that practice should continue and that will help? And do you have some comments on the disaggregation of information?
Yeah, sure. Thanks, Sanjeev. Yeah, I think on the first one, I agree with Kedar and what Mr. Ramakrishnan said, I think is that you should disclose the total of unusual items on the face. That will be relevant information for the users, and then the detail can be in the notes. On the disaggregation, I have a few comments. I think one is that by the very format of the profit and loss statement, which is now recommended, there is already a step towards the disaggregation of some of the expenses. And I think earlier panel, we had a discussion on foreign exchange. And therefore, foreign exchange differences will automatically get classified between operating and financing activities. And though I think there was a different view there, I would actually support this. And I think the IASB has made a move in the right direction. In India, we're seeing a mixed practice, and I think it might involve some change for companies to do. The second thing is that I think the significant improvement the IASB has made is on now defining or giving more detail on how to disaggregate, and they have used the principle of shared characteristics. I think this is an important concept, and they have given examples of few shared characteristics which should be evaluated for assets, liabilities, income, and expenses. And my view is that this is going to be very judgmental, and it should be important to emphasize on the relevant evaluate. And I'll give a very simple example. There are companies which arrange funding arrangements for their suppliers and for, let's say, raw material. And the issue comes up on the classification of this. And I know it's a major item which is being discussed on a separate basis also. But here the issue comes that the nature of the liability, is it a liability for raw material? And therefore, is it in the nature of, even though payable to a bank, should this be more a trade payable? Or should this be a debt or a borrowing? Because the creditor is a financial institution. So I can change the classification depending on my view. If I want to look at it as a nature of the transaction, I'll say it's purchase of raw material and the liability is in that context. Or I would say who is the nature of the creditor, and it is a financial institution, so it may be in the nature of a debt or a borrowing. So I feel that there could be more guidance on what these shared characteristics should be and how they should be evaluated. I think that is one. The second is, of course, in India, we don't have functional expense classification. So I think some of those proposals may not impact as much, but it is very common for companies to show research and development and corporate social responsibility expenditure as single line items. I think there we will get impacted by these proposals, and I feel rightly so, because to do a mixed approach, which is partially functional and partially on the nature of expenses, probably not appropriate. So I think that is also again in the right direction. And one other comment I would leave on the disaggregation for IASB is items of the nature of foreign currency differences and derivative gains and losses. They change in the nature of the balance. They are sometimes and sometimes losses. And sometimes they are part of other income and sometimes they should be in expenses. But that makes comparability very difficult. For example, the previous year it may have been a gain, this year it may be a loss. And then it's even more complex because quarter it may be a gain, some quarter a loss. So you can't keep moving the line to which it relates. And I think that can be mitigated by a consistent approach. Whatever approach is taken is done consistently over a period of time so that you don't keep changing the line items. I think that impacts comparability and increases the volatility because the same item features in different places. Otherwise, I feel, Sanjeev, I think these disaggregation rules are very useful and will be better guidance than we had in the past.
Yeah, thank you, Sudhir. Kedar, one last quick question to you on what Sudhir mentioned, that instead of shared characteristics, if it can be relevant characteristics, that would be better. And secondly, on this foreign exchange. So what's your view on both of these?
Yeah, Dr. Sanjeev, you see, all of us who have been in the accounting profession, we have grown up examining, whether if you have traveled for a training, is it a travel cost or it's a training cost? I think we have tried to solve all these kind of questions right from the beginning and entry into the profession. What I will say is what will help in matters like this is consistency and relevance. So a clear statement on consistency, materiality, and relevance is probably something that board can consider to be added to it, because then the divergent practices, then the scope for applying mind will go away. And I think that will bring a lot of peace to the profession and that will simplify a lot of things. So I would go for that, because I have noticed that, the board had stepped short of prescribing, again, just to make the point, because in one of the basis for conclusions, board clearly mentioned that, it has rejected the quantitative thresholds for disaggregation. For example, requiring separate disclosure of any balance over 10% of the revenue, for example. Some of the Indian standards, are very aggressive in some of this. So that I think board has little shied away from. Secondly, board has also rejected introducing a mandatory template that would require specified line items. That would make things easier and simple. So I think this is a particular stance that the board is taking, and I appreciate where they're coming from. But I think to echo what Sudhir said, I think a clear statement on consistency, materiality, and relevance. Probably relevance should be rated a little high, because eventually if a reader of a financial instrument is not able to interpret what is being published, that will be an issue. So that's the answer to what you asked, Dr. Sanjeev. I will make one comment on unusual item and then I'll stop. I think what is also mentioned in one of the basis for conclusion is the impact of the unusual items is expected to be included in only one footnote. So if the impact is spread across 4 or 5 line items, current exposure draft recommends that all of that has to be accumulated in only one footnote. In my view, what will help if the respective items which are included, if the footnote is made in those applicable, footnotes, so that readers can appreciate the impact in that specific item. For example, cumulative unusual item might be spread in employee benefits, it might be spread in travel expenses or, material costs. It will be good if, individual footnote has a reference to unusual item rather than all of that being accumulated at one place. Thank you.
Sure. Thanks, Kedar. And as far as the relevance, materiality, and consistency is concerned, so these are the characteristics. Actually, consistency is a fundamental accounting assumption along with going concern and accrual. And as far as relevance and materiality is concerned, these are the essential characteristics of the financial statement. So I'm sure that IASB will have that in mind, that these would certainly be considered. So I would like to thank all the 3 panelists and kindly stay on, because we'll also be doing a poll. And but before that, I would like to invite Sue Lloyd and Nick if they have any comments on the discussion which we had in panel 2. Over to you, Sue and Nick, in whatever order you want to take it up.
Well, I think we'll go in the same order, just having a look here. So I'll just go in the order of the questions here. And in terms of disaggregation, I think Sudhir made a good point about looking at the package of proposals in how it addresses disaggregation, and not just within the ones I talked about pertaining to disaggregation, but the board very much did recognize that this introducing the subtotals produces some degree of disaggregation, as well as the different aspects that we're looking at. Now, I appreciate there was a comment made that we could potentially be more directive in how disaggregation is approached. This is always a balancing act between not tying companies' hands to do something that doesn't make sense, but at the same time giving them enough direction to do the right thing. And then this sort of suite of proposals together tries to its best to achieve that. I appreciate particularly around the comment around maybe expanding more on characteristics and how to apply those. I think that's good feedback that we'll take away and think about how we might be able to do that. I think coming around to the unusual items, there was a lot of talk about the distinction between whether it should be within the notes, within the faith, and I know some of the feedback was sort of both supportive in some respects and sort of contrary in other respects, and I think that's sort of reflective of the feedback that we've gotten across the board. I think specific to the point about being on the notes, one of the panelists mentioned this sort of was discussed at quite a bit of length, and the board came to the conclusion that really it could be misleading to see an item put as unusual on the face of the statement of profit and loss without the explanatory information about why that's unusual, and particularly when we're trying to make this distinction between the nature and the function. Typically, a lot of unusual items are a collection of items or allocations, as in a function, just as is done in a function. And so a line item that's just called unusual, that doesn't break out all the various components of what that is, can be difficult to understand without all that explanatory material. And so that's as was pointed out, why the board concluded that the best place for that is in the notes. I will point out that it's not nowhere in the exposure draft does it prohibit unusual being on the face, but for the reason I just mentioned about this usually it being a collection of expenses that would go against this nature and function, it would also need to be respectful of the subtotals that are required. It becomes more difficult to put in something called unusual, and so that's also a practical challenge to going down that road. Mention was made about the several future reporting periods aspect of the definition, and I mean I think the board appreciates there's some elements of judgment there, but at the same time didn't want to get into a position where it's very prescriptive, saying something that's 3 years, that looking for 3 years down the road is unusual, but 3 years plus one, that's not, for example. I mean, these are the types of issues that come across, and so there's the idea is to give a bit of flexibility from that perspective to make sure you don't get these hard cutoffs that don't make sense. Now, in terms of looking at multiple periods, I know this was a concern that was raised. Some of these unusual type items tend to be large items. They can span over particular periods. I think the definition is really trying to get at this predictive value and how it's going to go into the future. So I think I would make the distinction between there's the ability in the definition to identify an item as unusual by amount. And so I think we have an example in the exposure draft of the legal expenses or something that's likely to be ongoing over time. That doesn't preclude if you have in 1 year a significantly higher amount than would be expected to continue into the future. That significant amount in that year could be considered unusual by the definition, and you're not precluded from doing it because of the small amounts that continue into the future. I think what is trying to be avoided, though, is because of this predictive value. If you have something that is a large amount and it's going to continue to be a large amount for a number of future periods, 2, 3, 4, the feedback we get from investors is they want to be including that in their model because they know that that's going to be continuing to go forward, and so that's not the type of items that this is trying to capture. I think a good recommendation was made about going back to this period of time and the several future periods, disclosing the amount that's been considered may be something to take away and consider. And then I think the last thing on the unusual, I think I've addressed that already, but the unusual being, sorry, I wanted to say, so the panelists had spoke about the unusual being only in one footnote. The investors tell us that it is helpful for them to have all of the information in one place. What it doesn't do is preclude you from also disclosing it in another place. The important aspect is to have all of the information in a single note. And there is an interplay. I know it was mentioned with management performance measures potentially, and the exposure draft does allow for, to the extent that all of the unusual items are included in a management performance measure, as long as all of those disclosures are done together, that can all be in one note, and that still meets the one place. But I think it's important to make the distinction that because it's in one place and an important place to find doesn't mean that it couldn't be in other places as well. It's just that we need to have a collection, because that's what investors find important, to be able to identify these are the ones that are considered unusual and find those in one place. So I think those are the ones I wanted to touch on, and maybe ask Sue if she had anything she wanted to
add. Thanks, Nick. Like last time, I'll just comment on one thing for you to think about, to being selfish, that would help us in our redeliberations based on what I've heard you talking about today and what I've heard in other outreach meetings. Quite a few people have pointed out to us some of the consequences of the proposed unusual definition, and you have noted a couple of them today. So a couple of the ones that arise are the fact that you could get a different outcome simply because, excuse me, an item straddles two reporting periods. It might not meet the definition of unusual, whereas if it had happened to fall all inside the reporting period, it would meet the definition of unusual. And it seems odd that there's such a stark difference just for a slight timing difference. And the other one is that people often are of the view that you could have something which you only expect to arise for, say, 2 or 3 years, but it's still unusual in the longer term of an entity, and it feels unusual, but it doesn't meet the definition. And I think those are both fair points. But what would help us would be to think about how we balance those comments with what our objective was. So if you look back at what our objective is, put in really simple terms, we were trying to identify on a consistent basis for investors the items which were only really going to happen, at least in the amount that they occurred in this period, during this reporting period, so that the investors, when they're modelling sort of their expectations for future profit, they know to exclude those items for modelling purposes. And so you can see, if that's what we're trying to think about, the fact that it's going to be in this period but not in the next period matters a lot. And so that's why the cut-off matters a lot. So I do think the points about straddling periods or being only for 2 or 3 years are valid ones. So I think if, when you're responding to us, you have any ideas for what we might be able to do if we expand the definition of unusual to be more than just that one reporting period cut-off, what we might be able to do in terms of disclosures or other information that would enable us still to get that information to investors so they know what to do with these amounts for modelling purposes, but in a way where you think this unusual number might be a more, a better reflection of what a company might think of it as unusual. If you could help us sort of bridge those two views, that would be, I think, for me, something really helpful for redeliberations. Something a bit more granular, I think, is perhaps what we need, rather than the blunt approach we took with this proposed definition.
Igneshji, will you run the...
Hi.
It's time for Sanjeev ji.
Now, the poll question.
Devang, can you please put up the poll questions, Devang, please? Fantastic. Thank you so much. The board is proposing to provide the fixing expenses.
Jagnesh, please go ahead with the poll questions.
Yeah. The first question is the board is proposing to prohibit the mixing expenses by nature and by function in the statement of profit and loss. That is, I mean, earlier it was either nature or function, but now this is a combination of these. So do you agree with you? So please express your opinion by saying either yes or some should be additional line item or additional presentation. Please express your views. The second question is concerning the board is proposing that the entities present expenses by function in the statement of profit and loss should disclose the expense in the notes to the accounts. I think this is what is happening now, that you present the expenses in the statement of profit and loss by function and then give the details thereof as per the nature in the notes to accounts. This is the present prevalent practice, but still say yes or no. And the third is, do you agree with the proposal to require the information about the unusual income and expenses? Now, this is a very, very vital and important question, and you need to really debate on that. I implore participants to please take part in the poll and express your opinion, because we want to hear more and more opinions from them. And this will give the basis to the IASB and to IASB whether they should go ahead with this or not, and of course, it's your right to be heard. So, how long time, Devan, have people started responding? Devan? Hello, Devan? Guys, please do take part. We want to hear from you. We want to hear your words. We want to hear your opinion. And to see that. So how much more time, Devang, you need? 2 minutes. Fine. Yeah, we must give them time to think. By the way, Dr. Saab, it is a very interesting and mind-absorbing session. Dr. Sanjeev ji.
Thank you, Jagnesh bhai. I think it's time to show the results. Because we are running slightly short of time.
Yeah. Computer ji, please show the results of the poll. Now the poll's results are out. Computer ji, please say out. Oh, that's great. As far as question number 1 is concerned, that 26% say that they don't agree. 60% say. I think Devang, can you please display this second option, because second option 60% of people. Devang, can you please flip for a minute, please? And yes. Thank you so much. Thank you. But there should be additional items always presented by nature. That's goodwill impairment. That's fine. Very good. Now come to the responses for the second question. Devang. Okay, 60% is proposed entities present expenses by function. This is the same as the present condition, that you display the items, present the item as per the nature, function, and then give the details as per the nature in the notes to account. I think, Sanjeev, this is the present prevalent practice, and people tend to agree with that. They want to continue with it. Yeah. Oh, and the third question, do you agree with the proposal to require the information about the unusual income and expenses? Oh, that's fine. Okay. I know the option, dear. Thank you, Devang. Please let me have to look at the response. Okay, 43% say they don't want it. So it's just cut to cut. By the way, there is one breaking news from Nikita Bothra, and that is the number of participants, viewers have gone up to 1,700. 1,700 is the number of participants. So big claps to all of you. So you guys made it so interesting. Itana rasik bana diya. You made it very interesting that people are now looking for it, and that's great. Thank you very much. And now we'll have the.
Thanks, Jagnesh bhai. Thanks, Jagnesh bhai. Our own, Sayani.
वेणु भाई आपने प्रोग्राम इतना रोचक बना दिया कि लोग आपकी तारीफ कर रहे हैं, हटने का नाम ही नहीं लेते। अगली पायदान पे that means panel number 3 discussion is about
And before that Jagnesh bhai, let me thank all I'm sorry. Kedar, Ramakrishna and Sudhir Soni for taking out the time and actually speaking what they actually felt about it, and the very nice and candid response from the International Accounting Standard Board from Nick and Sue both. Thank you very much, and hope to see you soon in some more panel discussions. Thanks to all the three panelists.
Thank you, Dr. Sanjeev.
Thank you.
Thank you. Thank you.
Thank you all the panelists for sparing your time and sharing your views and wisdom and making it very interesting and interesting.
And you are welcome to stay on for the third panel. I mean, it will go up to 7:15. But if time permits, you're most welcome to stay on. Thank you. So now it's the time for the third panel. It is exactly 6:45. We are running behind schedule by 5 minutes, but I think that should be okay looking at the kind of interest that's been generated and the fact that there are more than 1,700 plus people on this highly technical subject. So now this brings us to the third panel, which is on the management performance measures. And so this panel will first see the presentation from the IASB Executive Technical Director, Nelly Shah. But before that, I would like to introduce our esteemed panelists. The first panelist is none other than our Honorable Past President, CA Nilesh Vikamse. And I had the pleasure of working with him when he was the council member in his first term, and I was a co-opted member in the Accounting Standard Board, and we were converging with the IFRS in India. So we used to have rounds of discussion. Nilesh Vikamse was elected as a president of ICI for the term 17-18 and was a part of the Central Council for 3 consecutive terms of 3 years. And during his tenure as the council member, he has been the chairman of various committees, very important committees like Financial Report Review Board, Expert Advisory Committee, Research Committee, Board of Studies, International Affairs Committee, and so on. He has also been the presiding officer of Board of Discipline and Disciplinary Committee. He has been Category A observer on the IFAC board, member of Technology Advisory Group of IFAC. He currently holds director of several corporates as SBI, Life Insurance Company Limited, Thomas Cook, SOTC Travel, SBI Card, PNB Housing Finance. But besides that, we know him as a hardcore technical expert who always brings so much of value on the table and gives his best to the profession, takes out a lot of time for the benefit of the profession. We thank you, sir, for taking out time once again for ICI. And our second panelist is Mr. Ramesh Karnakaran. He is a director of the CRISIL, and he has more than 15-year experience in the credit rating and business and financial analysis. As part of the Center of Excellence, he has been leadership role to formulate criteria for the rating of the debt instrument, so very important in the new sectors and innovative instrument. That's really interesting. And he has obtained extensive experience in testing and developing criteria and new products across sectors. He has published several criteria articles as part of the criteria management role. We thank you, Mr. Ramesh, for being part of this panel today. And so before I have with the panel, I would like to invite Ms. Nelly Shah, Executive Director Technical, to give a brief presentation on the topic under discussion. Over to you, Nelly.
Thank you, Sanjeev, and I'll just give it a few minutes for the slides. Perfect. So as Yagnesh mentioned, we are on our final panel of the 3 main proposals that the board has discussed in this exposure draft. This one is on management performance measures. Now, I'll explain what a management performance measure is in 1 minute, but just for the time being, think of it similar to a non-GAAP measure or an alternative performance measure. So things like adjusted operating profit, adjusted EBITDA. So if we can go to the next slide. We'll start with what is the problem that the board is looking to solve with these proposals. And what we have found is that non-GAAP measures are very prevalent in their use. The staff looked at a sample of 100 entities, and we found that 90% of these companies use at least one non-GAAP measure. And that in and of itself is not a bad thing. In fact, going back to some of the previous panels that we've listened to, it helps with the issue about, on the one hand, the board is looking to provide additional comparability, and it's doing that through more structure on the statement of profit or loss. It's doing that through more subtotals in the statement of profit or loss. But on the other hand, there might be some concerns about this idea of operating profit being a residual measure, some concerns about whether certain things should be included in operating or elsewhere. And so with non-GAAP measures, companies have the ability to tell their own story, and investors are interested in hearing from management directly. So it is a good thing. The problem, though, is what the board is trying to solve is this lack of transparency, that there are problems with the disclosures not being very clear. There are problems that it's difficult to find the disclosures on these non-GAAP measures. And then we've seen issues where the calculation of those measures can change from one period to the next, which creates even more difficulty for investors. So the board is proposing a number of things in this area, but fundamentally what it comes down to is requiring that a subset of these non-GAAP measures are included in the notes to the financial statements, and also requiring specified disclosures to enhance the transparency and the discipline around these measures. And if we can go on to the next slide. Now, I've promised you I would explain what is a management performance measure. So it is similar to a non-GAAP measure, but you can see the definition on the slide here. First is that management performance measures need to be used in public communications outside the financial statements. So this could be press releases, it could be investor presentations, management commentary, anything outside the financial statements. And the reason the board is requiring this in the definition is that the board is looking for consistency in the story that management is telling outside the financial statements as well as inside the financial statements. It would be confusing if there were different measures outside than what's inside the financial statements. The stories may not be 100% the same. The second criterion in the definition is that the measures complement the totals or subtotals specified by IFRS standards. The goal here is that the IFRS standards, the measures under IFRS standards are the key measures, and the management performance measures complement, but they're not superior to the IFRS measures. And then the last criterion is that these measures communicate management's view of an aspect of financial performance. So it could be the case that there are performance measures, non-GAAP performance measures outside of the financial statements, but they may not necessarily be included as a management performance measure in the notes to the financial statements, because perhaps those measures that are outside are there for regulatory purposes or for other reasons, and management may not consider them to communicate their views of financial performance. You could also have a situation where a company just communicates its views of financial performance using the specified IFRS totals or subtotals. And in that case, management would have no management performance measures and it would have nothing to disclose. And that's perfectly fine as well. So if we go to the next slide, this slide goes into a little bit more detail about management performance measures and more about what is the difference between management performance measures, MPMs for short, and other types of non-GAAP measures. MPMs do not include non-financial performance measures. So anything related to that's not based off of a currency unit. So it could be square footage, it could be the number of eyeballs that visit a website, the number of subscribers. It's looking at things that are financial in nature, and it's looking at things that are performance-based. So for example, measures that are related to liquidity, measures that are related to ratios from the balance sheet would not qualify as management performance measures. And then, of course, anything that is already defined or specified by IFRS standards would not be a management performance measure. And the reason, starting first with why don't we include IFRS specified measures as management performance measures is probably obvious, because there's already IFRS requirements on this subject. So we don't need to require additional MPM disclosures for these types of measures. And the reason that the board is focusing on just this box within the slide of as management performance measures is that these proposals are intended to support and complement the full package of proposals. The previous panels talked about providing better transparency, better discipline and comparability on the statement of profit or loss. And so we're focusing here on trying to improve the story that management tells with respect to the statement of profit or loss. The concern is that if we went to other measures such as non-financial measures or balance sheet measures, it could significantly expand the scope of the project, which may impair the ability to finish this project in a timely way and get some good positive change out to investors of financial statements. A couple other things that I'll mention is that the management performance measure definition does not have restrictions on its calculation. One of the things the board talked about or thought about was whether there should be restrictions that any adjustments need to still comply with the recognition and measurement requirements in IFRS standards. So as one example, perhaps a company had a business combination and in its IFRS financial statements, it would reflect that business combination, but maybe as a management performance measure, it might wish to show the effect of that business combination using the historical cost of the target. The board thought about, well, should it restrict and prohibit those types of measures? And the reason it decided not to do so is because of the importance of giving management the ability to tell its story. So really, there's only one, I'll use the word restriction, but it's really just a general requirement that management performance measures need to be a faithful representation and they need to be understandable to investors so that they don't mislead investors or confuse investors. So that's the background on what a management performance measure is. In a minute, I will go into the disclosures that are required or that the board is proposing to require around these MPMs. But before I do that, if we could move on to the next slide, I wanted to spend just a minute on EBITDA. This is an area where we receive a number of questions on the proposals. And you might be wondering, in Nick's presentation on the subtotals, he did not say that EBITDA is a defined required subtotal. The board does recognize that this is a widely used subtotal, and it had extensive discussions about whether and how to define it, and it decided not to do so. So you might be wondering, well, why is it not defined? And if it is not defined, then does that mean it's a management performance measure, which would require all of the disclosures that I'll talk about in a minute? And so starting with that first question about why is EBITDA not defined, if you look on the left-hand side of your slide, you'll see a couple of reasons. The main one really is that the board could not identify a single underpinning concept. Some investors think about EBITDA as a performance measure, some think of it as a liquidity measure, some think of it somewhere in between. There are lots of different views on what exactly EBITDA is, which made it quite difficult to try to nail down a concept for it. So then you might be thinking, moving on to that second question, if EBITDA is not defined, does that mean it's a management performance measure requiring additional disclosures? And the answer is maybe. If EBITDA is really just as simple as operating profit, as defined by the IASB, before depreciation and amortization, then in that case, there is no required management performance disclosures. It's quite straightforward. Where you start getting into additional disclosures is if there's this adjusted number, if it's something that's different from this operating profit before depreciation and amortization. So then the last thing you might be wondering is, well, if the board has this notion of operating profit before depreciation and amortization, why not just call that line EBITDA? And the reason is simply because the label can be confusing. EBITDA, the letters stand for earnings before interest, taxes, depreciation, and amortization. So if we say EBITDA is the same as operating profit before depreciation and amortization, it means that EBIT must be the same as operating profit. However, that doesn't quite work because if you remember from Nick's presentation, operating profit does not include all earnings. It doesn't include, for example, investment income and expense in that line. And so the acronym of EBITDA wouldn't work. So the final takeaway on this slide is that the board has decided not to define EBITDA after quite a bit of deliberation, and it has not decided to call any of the subtotals EBITDA because it would cause confusion for investors. So if we move on to the final slide, as I had mentioned, I wanted to spend just a few minutes talking about the additional disclosures that the board is proposing to provide this transparency on management performance measures. Now, many of these disclosures are actually similar to what regulators already require in some jurisdictions. The difference, though, is that currently different regulators require different things. So the idea here is that we'll get some comparability on a global basis. And the disclosures, as you can see, include a reconciliation to an IFRS specified measure. And so that could be a required subtotal, such as operating profit, or a subtotal specified in the exposure draft. So there are a few subtotals that are commonly used, commonly understood, and it could be reconciled to that. So such as gross profit, operating profit before depreciation and amortization, as I mentioned, or profit before income tax. It also requires that the disclosures provide clear labeling and an explanation of how the measure is calculated and any changes in that measurement. Companies would also need to disclose a statement saying that MPMs are not necessarily comparable across entities. And in a part that is, I think, unique to the board is proposing disclosures of the effect of income tax and non-controlling interest for each adjusting line in that reconciliation. And the idea here is that this information would allow investors to determine adjusted earnings per share and recalculate this management performance measure if those investors don't agree with some of the lines within the reconciliation. Other requirements, just to flag, is that the board is requiring that these disclosures be in one place to the financial statements. This will help with the issue that in the current situation, it can be difficult to find all of the disclosures. And then the board is looking to, by including these disclosures in the notes to the financial statements, the board is looking or considering that some companies or some countries will also have those financial statements be audited, which would enhance the discipline and the value of the information that is being provided. So that is, in a nutshell, the requirements in the exposure draft of management performance measures. And I will turn it over to you, Dr. Sanjeev, to
Thank you very much, Nelly. Thank you very much, Nelly. Yeah, thank you very much. So we are running slightly behind the schedule, but we would not like to cut short on the panel discussion because we have two esteemed panelists and we would like to have the benefit of their experience. So my first question is to our Honorable Past Presidency and Nilesh Vikamseji. Sir, with regard to the management, so first of all, I'd like to express my sincere thanks on my behalf and on behalf of the Accounting Standard Board for taking out time and being here. So the question to you is that the IASB proposes to bring in some kind of a discipline which Nelly talked about regarding the additional performance measure disclosures made by the entities, which we call them as non-GAAP measures of the performance indicators. What would have been the trigger for proposals? And since you are the audit committee chairman and board member for many reputed companies in India, do you think it will provide better information to the stakeholders, sir? Nilesh, we can say, sir, are you able to hear us?
Thank you, first of all, as well as with this. Can you hear me? Can you hear me? Yeah, audible?
Yes, sir. Now it is
Hello.
audible. Yes, sir. Now it is audible. Yes, sir.
Am I audible?
I think with your video off, we can hear you very well. So there's a good idea. Put your video off. Now we can hear you, sir.
Now it's better?
I was able to hear the word, now it's better.
Hello?
Yeah, we are able to hear you, sir.
Can you?
No,
Can you
Yeah, so and then sir will come back.
Thanks for being here. My question to you is that IASB has proposed an explicit and formal definition of the management performance measures. What's your view on the scope and coverage of this definition? And do you think it will eliminate all the problems we had in this area? I think we have a connectivity problem with both the panelists.
Yeah, hello. Am I audible?
Yeah. Yes, Ramesh. Yes.
Yeah, I mean,
yeah.
Should I take the question?
Absolutely. Okay. Absolutely. Please go ahead.
Yeah. So, I mean, yeah, it's an excellent measure in terms of the scope and coverage. Definitely, this is going to help all the rating, especially the rating community. If you look at a rating agency point of view and also an investor point of view, what we look at is the comparability, transparency, and consistency. These are the three important measures. One is, when we go and meet the management of any company, they typically talk about their own performance goals and what their management performance are. So when they speak about their management performance measures, we should be able to connect it to the annual report also. That will help us in a big way. So this step is going to be a great step in terms of us to connect the annual report and what the story we are hearing with the management about the future steps that they are taking. Well said that, some of the key issues that I would like to highlight is, there are three things. One is consistency over a time period. That is extremely important. The second one is comparability to other players in the sector. See, what we do is, say, for example, I take a steel company. I would like to compare, say, the EBITDA per ton the manufacturing, the EBITDA per ton for producing one, for a steel company with another company in the same geography. This becomes extremely important. So the kind of management measures that a company take is also extremely important. So to that extent, some guidance could also be given that, some common standards should be taken, some industry standards should be taken. That would be quite helpful, although the management is free to take their own measures. And also, one of the key scope is the adjustments. Adjustments should be very transparent. Adjusted for all the unusual or the non-recurring items and reconciling with the reported P&L provided by the IFRS. That should be quite helpful for us because we would be trying to decipher what is the reported number with the management performance measure. Finally, the most important thing is reporting should also be at a segmental level because each company will have, different geographies or a different segment. When we are comparing the business performance of one company with another company, which has several segments, so providing the management performance across segmental level and how that reconciles to a overall P&L or the line item, that will also be extremely useful for us. These are some steps that can be taken to improve the overall reporting of the management performance measures.
Thank you very much, Ramesh, for the answer. And our Honorable Past President is back. There was some bandwidth issue, and that happens in the virtual mode. Sir, I have already asked you the question.
Yeah,
if you
I heard the question.
Sure, sir. Please go ahead, sir.
You are able to hear me right now clearly?
Yes, sir. Absolutely.
Wonderful. So first of all, sincere thanks to you, Sanjeev, the Vice Chairman, MP Vijay Kumar, Chairman, then Sue Lloyd, Vice Chair of IASB, Nick Barlow, Nili from IASB for this wonderful outreach which is being done on the exposure draft of the general presentation and disclosure requirements, the new standard which is coming. Let me compliment the IASB for a wonderful exposure draft. The discussions on the subtotals and categories, disaggregation, unusual items, and now talking on the MPMs, the management performance measures. So as we know, Sanjeev, the whole backdrop of this management performance measures have been the fact that we have got various stakeholders amongst who are users of the financial statements. We have got banks, we have got the tax authorities, we have got, but one of the most important users is the capital markets, the investors. And what has been happening, maybe if you see the evolution of the accounting profession and the financial statements, earlier I think the financial statements were the base for the capital markets. But as we see now the way the analysts, the equity research analysts or the investor analysts are coming into the fray, and the way they are coming out with a lot of this management performance measures for their own assessment, for their own valuation as well as the determining the valuations. So that is where these MPMs are coming up, and the fact that IASB has embarked on this journey, I want to compliment them. It may be possible that we may not reach the whole distance, and we'll discuss and debate, what is possible and not possible, and we'll give our feedback to the IASB. But the fact that IASB is getting into the management performance measures and taking cognizance of the market, I think that will add a lot of value to the financial statements. And as Nili rightly pointed out, the way currently the MPMs are being, put across in the other parts of the annual reports, and the lack of consistency in the way it has been calculated, etc., is definitely an sort of issue which needs to be plugged. And I think this standard will help plugging those inconsistency, if I can say so. But having said that, I think we are going just partially into that direction. I think, as Nili pointed out, there's been a major debate in the IASB on not factoring in EBITDA, as one of the MPMs. And I think, in my view, I'll request Sue and the other members this has to be there. If you look at the manufacturing world and look at the way the valuations are going about, it's absolutely on EBITDA. What my suggestion would be in that particular thing is, how do we sort of have a reconciliation to the operating profit to the EBITDA? I agree that the operating profit will not have investment income, will not have the other incomes. So I think we can have a reconciliation which can be part of the note, but I think EBITDA is one of the most important, MPMs which has to be considered. That is as far as the manufacturing world is concerned. When we come to the banking and the financial services, we have got issues like margins, the return on assets. There are certain benchmarks, and when you come to insurance companies, we have got the embedded values, embedded value of the company, then the value of companies. The actuaries do some calculations and come out with these embedded value, etc. I think it needs to be brought into the financial statements, and it has to be reviewed by the auditors. It has to be, the preparers have to be made accountable for it, and it has to be, so that's my take on, and I'm really happy that IASB has come out with this particular, standard, the exposure draft. And as I told you, it's still partial, but I think more to go. I want to recognize the presence of Dr. S.B. Zavre, past chairman of Accounting Standards Board and the chairman of the AOSSG.
So thank you very much, sir. Yeah, thank you very much. In fact, EBITDA is very close to the heart of, I think, almost everyone, whether it is the preparer or the auditor or the, if I have to say, the capital market. In fact, to the IASB, we would also like to say that our Schedule 3 is also likely to see some of the ratios being given, because in our new company's auditor report order, the auditor is required to comment on the going concern, and that will happen with respect to certain liquidity and solvency ratio. And this, I would also like to ask this question from Ramesh and Nilesh also. So question to you, Ramesh. Do you think these indicators which have been left out, like the financial ratios, liquidity indicators, growth indicators, I mean, these should also be included in the MPM? To me, partially it's going to be there in any case, as it appears from the new CARO, and it will find a place in the financial statements. But to the extent it will not, do you think these should be included in the exposure draft?
Yes. I feel these ratios, these financial ratios are extremely important. They will be in the liquidity indicator or the solvency ratio. All these ratios are very, very important. Hence, they should be part of the management performance measures. Say, for example, a lot of times, we struggle to, when we do the rating from an analyst point of view, a lot of times we struggle to reconcile some of these ratios with the actual reported financial numbers. So, when there is a proper kind of a reconciliation given with the reported numbers, with these ratios, the key performance ratios, that becomes extremely useful for us to decipher the performance. And also this helps us to compare across several, other companies in the industries also. One more aspect that I would like to highlight also is, rating agencies also have their own consolidation approach, which means that we would like to, exclude or include some of the entities. Say, for example, if a company has a special purpose vehicle, which they are funding it on a non-recourse basis, then we may not consolidate it. So in these kind of cases, some kind of, at least for the key subsidiaries or the key entities that are getting consolidated, some level of, management performance measures should also be provided. That will help us to, do the consolidation and also understand the performance of these companies which are getting left out. Thereby it improves our analysis. So that's broadly what I want to say.
Yeah, so thanks, Ramesh. I think that will be helpful if a consistent definition of the various ratios is there. I would also like to ask this question to Nilesh sir also. Sir,
Yeah.
what's your view on this? Whether this should be included?
Absolutely, I'm in agreement with Ramesh over there. The fact that the solvency ratio, liquidity ratios, and if I could recollect from Neeli's presentation, she said one of the major handicap was the timelines for factoring in the balance sheet ratios. I would say the financial position ratios. So my again request or suggestion to the IASB would be to at least bring in let's break it up into two. One is, of course, you've taken the profit and loss measures or the income expenditure MPMs. Let's take, if depending on the time scheduling or whatever the board is sort of having the time pressure on, but let's take up the balance sheet ratios, the solvency and the liquidity ratios also into picture in the MPMs. To the extent it is non-financial performance based, like the customer base or the eyeballs, that could be phase 2 if that is going to take time. So in my view, whatever is based on the financial statements, I think those MPMs we should factor in at this juncture, and maybe at a later date even consider the non-financial ones. So that could be the phase 2, but phase 1, I think at this juncture we should include the ratios based out of the financial positions also as on the date of the balance sheets, whatever is there, whether it's debt equity ratio, whether it is the current ratios or whatever, maybe the interest cover, etc. Whatever the ratios are coming to.
Yeah. So thanks, sir. So you are also, a statutory auditor. So from that perspective, you think the overall proposals will make the life of the auditor, which is very, very difficult these days, slightly easier, or it's going to put more burden on them?
No, definitely, it will add to the work of the auditors. But having said that, it is in the larger interest. See, finally, if you're looking at not only the financial statement, but the annual report, if there is certain information which is not part of the financial statement or part of the annual report and which is subject to different, I would say, formulas year by year, there's no consistency. The management, please due respect, can sort of interpret in a different manner year on year. I think that's not advisable. It has to have authenticity, and that authenticity will come only if it is brought into the financial statement. Having said that, let me draw attention of this August gathering that the International Assurance and Auditing Standards Board a few years back has brought out SS 720, which talks of auditors' responsibility in relation to other information in the document containing annual financial statements. So I think that also is adding, responsibility to the auditor anyway. So there's going to be part of the financial statement. I think it will lend more weight to the financial statement, and the utility of the financial statement is going to go up. I think that's the larger aim. Here, Sanjeev, one more suggestion I have for the IASB. I think somewhere it is mentioned that we need to give a reconciliation of the tax impact and the non-controlling interest on the subtotal when we relate it to the MPM as Neeli presented. My suggestion there would be, instead of sort of burdening over, that should be part of the definition. But if it can be, it's anyway going to be subjected to the audit. So then do we need to sort of have so much confusion unless the way Nili presented that, of course, was not much of an information that can come in, but it's going to make the disclosure complicated. Then I would recommend let it be restricted to the auditors to verify how it has been calculated, with the definitions being part of the standard. But disclosure, whether to give it or not, I would leave it in the sense to make it simple to understand. That's what my suggestion is.
I agree, sir. There is already a disclosure overload, and I think IASB is working on that project to reduce the disclosures. In fact, sir, I had many questions, but I am already running behind by almost 14 minutes. I was supposed to conclude this by 7:05, but I know this is a spillover of the earlier sessions also. At this point of time, I would like to invite Sue Lloyd and Nili to respond to
Sanjeev, just one more suggestion.
Please, sir.
One more suggestion before we bring in Nili. There is, in the application guidance B83, which says if the management performance measure is, pertaining to an operating segment, it can either be included in the operating segment disclosure, or if it is shown separately, the whole disclosure has to be taken separately. So I didn't get what it is. My suggestion would be, wherever it is appropriately, the MPM is part of, say, the operating segment disclosure. Let it be there, and the other MPMs can be done separately. I think heavens are not going to fall in the sense in case there are two separate disclosure of MPM rather than being at one particular place, in one particular place in the notes to account. So that is again a suggestion that let it be aligned with whatever the disclosure coming in, whether by way of footnotes, whether by way of specific disclosures which are coming in of the operating segments. And also that was one point I wanted to draw the attention of the IASB. Thank you. Sanjay, it's all yours now.
No, so thank you, sir. So I would request now Nili and Sue if they have any comments on the discussion which has taken place in panel 3. And after that, I would like to move to Dr. S.B. Zavere, who is with us.
Thank you, Dr. Sanjeev. Sue, I could share a few thoughts, and then would you like to come in, or would you like to go first?
You go first, and then I'll just make a short comment.
Okay, perfect. I know we're running short on time, so I'll just cover a couple of points. Ramesh and Neelishji, thank you both very much for your feedback. It's very helpful to us. There were comments about expanding the scope of what the management performance measures are to include other measures, liquidity, solvency measures, other ratios. It is something we've heard from other outreach events as well. So you're not alone in what you're saying. It's something that the board will need to think about. But as I mentioned, even if we go as far as expanding to balance sheet and cash flow measures, it will require some additional work, some additional definitions. So, for example, what is capital employed? And that could, it's a balance. Do we want to try to get some immediate improvements, or do we want to take the time to do these other ratios in the near term, or maybe move that to phase 2 as well? So the idea of having an iteration phase 1, phase 2 is also very helpful. There were a couple of comments about disclosing segment management performance measures at the segment level, and then also disclosing some management performance measures in the segment note and other ones in the management performance notes. What I would note is that if there is an overlap between management performance measures and segments, then we absolutely do think about an opportunity for those two disclosures to come together. With respect to disclosing management performance measures at each individual segment, it may already be the case that if management performance measures are the measures that management uses to evaluate segments, then that would already be provided in the segment note. However, what we also heard from investors is that there are some management performance measures that are done at the consolidated level. And so it may not make sense to have those consolidated measures within the segment note. And then there was a comment about EBITDA and needing that to be a management performance measure as well. And certainly understand the feedback, and certainly have heard it from others as well. I think the thinking for the board was that EBITDA is, in some respects, for some people, it's already addressed through this operating profit before depreciation and amortization. So if that number is really what you're doing with EBITDA, it's already there. And then if you're presenting some sort of adjusted number, so operating profit before amortization, depreciation, and restructuring, then yes, that would be provided in the reconciliation, and it would have the consistency from period to period. It would have the clarity of what is exactly in each of those reconciling items. So you'd get some of that transparency, and then it would still be provided in that note. So hopefully that helps a little bit. But Sue, over to you to expand on anything else.
I'll be very quick given time. Thank you for the comments and thank you for the positive message as well. It was a big deal for the board to decide to dip their toe into management performance measures, so I'm pleased that it's viewed positively. Your comments on broadening of scope I've heard, I think, in just about every meeting that I've been in, which is interesting because usually people want us to narrow scope. So I think we'll need to think carefully about what we do about that. But we have been conscious in this project of trying to be very focused on the income statement, not tinkering too much with the cash flows, etc. And so I think that will be front of mind, but it doesn't mean we can't look at a second phase. So it's a good suggestion.
So thank you very much, Sue. And I would like to thank both the panelists, CN Nilesh Vikramseji and Rameshji, for their very, very valuable insights. And I would now like to invite Dr. S.B. Zavere. As Nilesh Vikramseji said, he has been a Central Council member for 9 years. He has been the chairman of the Accounting Standard Board, and now more importantly is the chairperson of the AOSSC. And we're really very, very proud that an Indian is now on that chair. And yesterday was his birthday, so we wish him a very, very belated happy birthday. He has also received the Lifetime Achievement Award for contribution to the field of chartered accountancy, education, admin, and social work, conferred by the Maharashtra Cosmopolitan Education Society and the Elena Institute of Management Sciences, Pune. He's a renowned educationist, and he has, I think, shaped the lives of thousands of students for over at least 3 decades, which I know, if not more. He's been ICA faculty for the IFRS certification course, not only in India, at Bahrain, Dubai, Muscat, Nepal. And I can tell you that currently we are running 17 batches of the virtual certificate course on IndAS. He and our Honorable Past President Manoj Fadnisji has been a faculty in every batch. That is the devotion and dedication which he has. So, sir, you've been a witness to today's panel discussion, which has really been very, very interesting. It's been 3.5 hours now, and you've been listening to this very, very patiently. I would like you to, to give your thought process and also give your concluding remarks. So, your thought process on this entire, Before
we hand over to we have the opinion poll to be done on the management performance measures. I think that's an important feedback we need to give to IASB.
Sure.
Let's take 2-3 minutes.
Okay, sure. So, can we have the poll?
Devan?
Maybe that was not listed on the agenda, that's why I missed out.
If it's not there, then let's leave it. I was thinking.
Actually, it was not there in the agenda.
Okay.
It's not. I agree. It's not in the agenda.
Then let's leave it then.
Okay.
I suppose.
So I would request Dr. S.B. Zavere to give his thought process and the concluding remarks. And I would also like to express my sincere thanks to the entire IASB staff, all the panelists, and my chairman, MP Vijay Kumar, and the MOC Yagnesh Desai, because after Dr. S.B. Zavere speak, I would like to hand it over back to Yagnesh Desai.
Thank you, Dr. Sanjeev Singhal, for making all the technical sessions interactive, informative, and very interesting. Thanks to MP Vijay Kumar for arranging such joint outreach program, which is rich in contents. Only because of the Nilesh Vikamsiji, I am the chair of the AOSHG, I must mention. And Dr. Sanjeev Singhal, I am in the profession for the last 47 years. So almost 5 decades I am reaching to soon. My dear participants, today's outreach program was a joint event of ICAI and IASB, primarily for the purpose of taking the suggestions for improving the transparency, comparability, and the performance reporting measures. Through better communication in financial reporting, primarily on these primary financial statements. You will agree with me that there were rich contents and the live deliberations by the panelists, by 2 illustrious past presidents, C. Amarjit Chopra ji and Nilesh Vikamsi ji, who is also here right now. The responses given by Mick, by Sue Lloyd, and the Nili was absolutely apt. That is very, very important. I think I am not going to talk about the technical deliberations and controversies and pros and cons because of the limitation of time, but I can only say one thing is constant in the world, and that is change. Whenever there is a change, there is a hesitance. The reason very simple, because we have to work more, and especially the preparers of the financial statement and the auditors, they have to take more efforts. However, such change is definitely welcomed by analysts, financial institutions, by the investors, by the capital market. And in order to manage the change, there is a benefit not only to the primary users, but there is a benefit to the secondary users too. Unanimity is difficult because accounting is not exact science. And therefore, there is no one answer as far as international financial reporting standard is concerned. Therefore, IASB has a tough task to do. They have to resolve the controversies, but they will do it with the experts' opinion. One thing I must mention, as far as today's deliberations are concerned, being a chair of the AOSHG and a member of Accounting Standard Advisory Forum of IASB, in one of the ISAP meeting of 2019, I have given one agenda consultation item, and that is nothing but standardization of financial ratios. Thanks to Nilesh Vikamsi ji, he insisted upon financial ratios. Sir, in 2019, based on our earlier discussions, I have observed in Asian Oceanian region that voluntarily the information is given by corporates, but they are only benefiting financial ratios, which benefits the corporates. And therefore, there is a need for standardization of financial ratios like IAS 33. And that exactly example I had given in ISAP meeting. Right now, AOSHG and in particular India, we are doing the research as far as standardization of these financial ratios are concerned. And to tell all the participants, there are a lot of controversies, and therefore IASB has accepted the project in principle in agenda consultation as far as standardization of financial ratios are concerned. Thanks for that. And even the AOSHG is also giving the feedback through the AO region. And in particular, when I say this ratio, we are, yes, talking about operating ratios. We are talking about financial ratios. We are talking about solvency ratios. And we are also talking about turnover ratios. And we are studying entire AO region. And even we have taken some of the corporate reports from Europe also for just understanding purpose. So thanks to you all for having these rich contents. I again thanks to CAMP Vijay Kumar, Dr. Sanjeev Singhal, Vidyadhar Kulkarni, entire accounting standards team, and naturally our Amin Sayani, Ignesh Desai. You made the program very interesting, and we are glad that what you're talking about is interesting. Continue to be MOC for all global programs, Ignesh.
Thank you, sir.
Thank you. And thank you for all panelists and our Honorable President Atul Gupta as well as Niyar Jambu Siraji. Thanks MP Vijay Kumar for giving me an opportunity to talk few words, because technically we can talk for hours together for the controversies and pros and cons. But I think this type of summary is enough. Thank you.
Thank you, sir. Thank you so much.
I just would like to know whether my Honorable Chairman MP Vijay Kumar would like to say something, or should I hand it over back to Yagnesh?
We'll hand it over back to Yagnesh. I think we are late. Sincere thanks to all.
Comment from
Sincere thanks to all.
Okay. Right. So you want to make any closing comment before I hand it over?
Back to Yagnesh.
I just wanted to say thank you very much. I found the discussion really interesting, and just 2 points. I think you've been incredibly constructive and positive, and I really thank you for that. It's refreshing to do outreach with such a good attitude. And also, I really compliment the panelists and those who have spoken on the level of detail of comments. I've been in a lot of outreach events where the comments are very, very high level. You've looked at the detail, and that's clear, and that's really helpful for us. So thank you very much for that.
Thank you.
Thank you, Stu, for those compliments. And back to Yagnesh Bhai for concluding the program.
In the first place, thanks to all the viewers and participants who made this program very successful. And thanks to Stu Lloyd, Nelly, and Nick, this outreach program has become an enriching program. It has enriched the professional, all of whom has participated and added to the knowledge and make it very interesting. Sanjeev ji, all 3 panels moderation was excellent. Okay, IASB Chairman sir, MP Vijay Kumar ji, thank you very much for conceiving this outreach program and polling along with the IASB. It was a great success. Thank you so much about it. And all the staff members, including Vidyadhar Kulkarni ji and Nikita Vukhra, and even this gentleman called Devang, for all your help. Thank you so much. Zawari Sahab, thank you. Namaskar ji. Nilesh ji, namaskar to you also. And I appreciate and salute our President sir and the Vice President sir. And thanks to Institute in general to give me an opportunity to be on this. And जी हाँ दोस्तों, वादा करता हूँ अगले बार भी हम आपके साथ इसी वक्त मिलेंगे. Thank you. Thank you all.
Thank you, Yagnesh Bhai. Thank you. With this, we come to the close of the program. Thank you very much.